All right, ladies and gentlemen, welcome back to day 2 of Business Standard BFSI Insight Summit, India's biggest, largest and most pertinent BFSI event. We witnessed in the morning, ladies and gentlemen, the outlook and vistas about financial risks that come fraught with climate change. And we also observed in our previous session by Mr. Joshi, who actually painted the picture about insurance globally and specifically in India, with India becoming the 6th largest insurance market by 2032, ahead of countries like Germany, Italy, South Korea, to name a few. And now as we move on to the next compelling panel discussion, the theme is the fact that in November 2022 itself, we had about 730 crore transactions worth 11.91 lakh crores via Unified Payment Interface, also called as UPI. With such significant implication, the question is, how is UPI going to impact the insurance industry? And the premise and the topic of the panel discussion is ease of doing business, the UPI moment of life insurance industry. I'd like to call on stage the following noteworthy personalities from the insurance industries to actually share their outlook and point of view with us. First, I'd like to call on stage Mr. Tarun Chugh, MD and CEO at Bajaj Allianz Life. And joining him on stage is Mr. N.S. Kannan, MD and CEO at ICICI Prudential Life Insurance. And Mr. B.C. Patnaik, MD, LIC of India. Mr. Mahesh Kumar Sharma, MD and CEO of SBI Life Insurance. Mr. Prashant Tripathi, MD and CEO of Max Life Insurance. And to actually navigate this panel discussion, I'd request Mr. A.K. Bhattacharya, Editorial Director at Business Standard, to come on stage and initiate this dialogue. Over to you, sir.
Thank you. We have this policy. Sure. Kamalesh, you have done for the paper? Okay. Sure, absolutely. Please. But that's a strange policy, no? No, it's not a strange policy. You know, we do it as a matter of our code of conduct. These things should not be used to finance people to promote themselves. And it's actually not on top.
Very good afternoon to you all, and Let me once again welcome such a stellar panel. I don't think even in my dream I would have managed to, get together a panel which represents Indian insurance industry at this level. So thank you once again, gentlemen, for agreeing to be a part of this panel. So in the next 1 hour, what we'll do is this. We will come to the end and discuss whether it is a UPI moment or not. But let me start by what Mr. Joshi, the IRDA member, talked about in the morning. And he gave an indication of how the insurance industry, the life insurance industry, actually played a stellar role in the management of COVID. So my question initially, if I could, ask you all gentlemen to let us know, let this group know that how has the COVID 2 years, because we're just emerging out of COVID, hopefully. I hope the new sort of thing does not upset us once again. So how has COVID been managed by this industry? And what are the key takeaways from this kind of event, Black Swan event? So may I start with Mr. Chugh? If you can just let us know in brief. All of us will go to the same thing because I think this is a central issue and this is one industry which has done, I understand, a wonderful job in managing the COVID impact on people, society, entities. Mr. Chugh.
I think it was a transformational catharsis.
Mm-hmm.
I don't have a better, I know it's a complicated set of two words.
Yeah.
I don't have a better set of two words.
It tells everything actually.
Yes. So that is really my headline statement on that. What it did was it got customers to understand. Unfortunately, when customers understand, for us it's usually not a very positive moment, that how important life insurance for them is. As a result, the sector grew despite everything else happening in the world. There were a lot of other sub-formats in which we kind of gained. The importance of digital, the importance of innovation, the importance of customer in the center of all decisions, the importance of risk and capability to keep processes simple, the importance of not a face-to-face meeting in life insurance, or the possibility of that. A lot of these trends kind of got super fast done, they got accelerated, and that's the right word. I think some things that we struggled on was on the term policies, particularly the core product, onboarding of customers at the back end, where we banked a lot on reinsurers. And I think that was a homecoming moment as well, where we figured out, jo karna apne aap hi karna, you have to kind of bank on yourself. And while the reinsurers had the data for the whole world and they could see, and it's good, but customers needed us there at that moment. And that is what I think we learned, that the processes had to be simplified and we had to take more risk on our books, and a lot of us have done that. At the same time, I think the insurance sector really stood up to the task in terms of offering its core value proposition, which is paying claims and paying them on time. And I think IRDA played a stellar role in that as well. And that is where I think customers did test the fact that insurance is important and it does pay to have insurance.
Fantastic.
I'll just leave it here.
Sure. Mr. Kannan, what would be your takeaway from the COVID experience from a life insurer point of view?
Yeah, good morning. Thank you for having me, first of all. And I hope through the next 1 hour, we have a good set of discussions. I won't repeat what Tarun said, but just I'll add on to it. Looking at the start of that period, without knowing what is going to happen when the lockdown was announced. And in the first and the second wave, especially second wave, where the mortality development was very high, it was a difficult period for the industry. That's the first thing, because it was completely unanticipated. We didn't know what was coming. At the same time, I would say that COVID was really the moment of truth for the industry, in the sense that why do we exist as life insurers? Ultimately to pay claims. I think that is our reason for existence, and when the customers or customers' families need us the most. So the moment of truth was tested, so to say, during this COVID period. So Tarun talked about the claim payouts. So we had to make sure that all genuine claims were paid on time. And the claims volume really spurted during that period, which we weren't really prepared for as an industry, because that kind of death claims is unusual. So long story short, I think industry stepped up well, thanks partly to the regulators' intervention as well. And I think we came out quite okay in terms of meeting the customer's promise during that period. That was the big takeaway for us, that our purpose of existence was reminded to us during that period. Yes, business is okay, fund management, all that is fine, but ultimately a life insurance company has to pay the claims when there is a death of our customer. I think that was the primary thing. Second, I think the need for insurance and the awareness became much higher. That is a takeaway. By no means I will say that it has really reached where it should be, because it happened for a brief time post the second wave, when people realized the importance of insurance and the demand just spurted, of term insurance especially. Of course, in the third wave, the mortality outcome was, luckily for the country, it was not bad. So obviously, a little bit of waning of that interest happens. But net, I think, post-COVID, compared to pre-COVID times, we have a better understanding and awareness of term insurance. I think that is the second takeaway. And the third takeaway is way of doing business. Be it the customers or the company or the employees, we were forced to do a little bit of technology tools were always there in the industry. But the adoption is about the necessity being a mother of invention. Unless you push to it, you don't adopt. Be it our employees or the distribution partners and everyone. So we were pushed to adopting technology which was always available, tools are available. So for example, in our case, if you look at the customer self-service post-COVID, it's 95%. 95% of the transactions are done through customer self-service. So even the sales had to be done on collaborative platforms, because we could not go and meet with the customers. And we had to really look at different ways of doing things, and work from home, work from office, all that we have heard of.
That's right.
So the whole technology adoption went to a different level, and I'm hoping that some of those good takeaways will stay with us even in the physical world, more of a physical world compared to the COVID world. So these to me is 2-3 takeaways of COVID period.
Thank you. Mr. Pannak, over to your assessment of how it, Mr. Chugh called it a transformational catharsis. Mr. Kannan talked about the moment of truth. How would you describe COVID?
I fully agree to what Mr. Chugh and Mr. Kannan said about it. And we should thank ourselves as a country. We should thank the regulator. We should thank the life insurance industry for standing up to such a difficult situation. And I think if there is some economic revival that is happening, some analysis can be made, and I think we can trace it to the good work done by the life insurance industry. So the figures, that means whatever IIDA statements say, it goes up to 50,000 crore in all total. Out of that, COVID might be a certain set of amount. But this amount of death claims being paid to the countrymen, and that certainly helps the economy. And the moment of truth was, yes, we knew how to manage in a COVID-like situation. There was adoption of technology by all the companies. We could understand that we could work from home. We could onboard policies through our agents, through online.
Yeah.
And a lot of transactions that can happen, like everything being credited to the accounts of people and all. Like we had to reach out to the district collectors, and they gave us the names. From the names, we traced out the policy numbers. We waived the policy, all other conditions in the policy document. And we ensured that within a period of 7 days, the claim is paid to the account, so that there is no difficulty to any of the dependents.
Okay.
So for the 2 years, we managed in a nice manner. As Mr. Kannan told, it was difficult time financially.
Correct.
But somehow we have been able to overcome all those situations.
Okay.
We hope that situations can be normal and without anything being affected to existing policyholders regarding their bonus rates and other things.
Okay.
So we have tried to maintain, we have tried to ensure that policyholders' reasonable expectations get maintained even after such a difficult situation.
Okay.
So we hope that things will become normal, and we also have learnt that in a difficult situation, yes, we are an organization, we can stand up and we can manage not only in the financial front, but also administratively and technologically.
Okay. Thank you, Mr. Patnaik. Mr. Patnaik's takeaway is that the industry stood up to the challenge, and I thought the additional point he made was that the Indian economy actually gained from the way the life insurance industry handled the COVID crisis. Mr. Sharma, what would be your takeaway from the way the industry handled the COVID situation?
Thank you very much for having me on the panel. One of the things, the first thing that we learned was that a good business continuity plan never goes waste. So, really speaking, nobody knew that such a thing could happen, and nobody in their wildest imagination would have thought, things would be so drastic. But thanks to having a good business continuity program plan, we were able to tackle that. So almost within 72 hours of the lockdown being announced, we were able to start processing claims, taking calls, diverting customer calls to our own people where the call center couldn't take it. And all those things were put in place. So, one of the things that we learned was that it is always nice to plan ahead and have a good business continuity plan, even though events may look very remote, but we need to have a very solid business continuity plan on that. So that was one of the things. And digital. So, to be at the forefront of technology was also very critical. And this was not something which we could have managed on the day that the lockdown was announced. So the idea that, we had tried to digitize many of our processes much before COVID struck, and that was what helped us to put together an alternate sales process, put together an alternate process from end to end, from application to claims, maturity claims, death claims, so that we could do it very quickly. Within a month, we had a full process which could be done digitally without a face-to-face. In fact, we used to have even digital CRPs and customer relations programs digitally. There were people who innovated. Our agents also adopted technology very fast, but that was possible because we had gone on that road to adoption of digital technology much before this event happened.
That's right.
So those are some of the learnings that we had early on. The other thing we learned was that conventionally insurance, or when you talk about mortality, you are thinking about old people, sick people, and vulnerable sections of people, poor people. But now we found out that there are diseases which do not respect any of these ideas. So insurance is something which needs to protect all these people. I think part of what Mr. Kannan also said about the awareness of insurance, being increased, was because you saw people like you getting affected, and not just the people. Like, for example, cholera or something like that happens, you are least bothered because you drink bottled water or you have an RO at home or whatever. So this was a total shift in that paradigm. So that was the other thing that we learned out of this this whole thing. So mainly, and the other thing is the awareness. I do agree with all of them, all of the speakers before me that the truth is in paying the claims. So we were able to do that, and I think as an industry, we matured during this period. So that is something which I think as a
Thank you, Mr. Sharma, for this. Your takeaway, as I would understand, is that the importance of a business continuity plan, the role of the digital technologies, and I think these are the two main points that you have added to this excellent analysis by three of your predecessors. Mr. Tripathi, if I can come to you and give us your assessment of how the industry lived up to the challenges of the COVID.
Yeah. When I reflect, I personally feel immensely proud of being one of the members of life insurance industry. And the way to assess that, all of us are financial services institutions. We work through our balance sheets, we have our capital requirements. One thing that I observed is during this period of adversity, I didn't find any of the players go bankrupt, go bust, run for capital, etc., which means the conservatism which got deployed in each of the companies, and thanks to the regulations, has been of a very superior order. This was a very unprecedented situation, once in 100 years event, which can cause drain on capital, which can make companies go haywire. I saw all the companies perform really beautifully well, which talks about the financial strength and the balance sheet depth of each of the companies. So number one. The way the regulators supported, I think they were in top gear. And all my colleagues will agree that the chairman himself, member FNA, member Life, all of them were constantly in touch, like never before, being on WhatsApp messages, etc., always checking on what we are doing, what help is needed. So I think that was a great tailwind that we got to manage. And the third, I mean, it was really, from my perspective, breaking of stereotypes. We always thought it is a face-to-face sales. It has to happen being in the office. The processes have to work in a certain way. Claims have to be settled in a certain way. All of them just got busted. And more at a human level, the way the industry came together, each of the employees and agents of life insurance industry came together to help the humanity. I'm sure all my colleagues will agree that they will have a few stories of heroism actually going above and beyond the calls of duty to help the customers, either to help at a human level or settling the claim, helping the families. It was completely unprecedented. So coming out of this experience, while all of us have our own learnings, I believe that we're all very proud of being in an industry which was relevant at the time of COVID, which did whatever is needed. And everybody will be very happy to know that we all tried very best to increase our claims paid ratios. I saw in many companies that the claims paid ratios got improved. I'm sure all my colleagues had decisions where they were reviewing claims on finding the reasons to pay rather than finding the reasons to decline, which again at a human level is a very big thing. So a lot of experience, a lot of learning. We come out quite enriched. The only letdown is as soon as the COVID went away, we saw a decline in a desire to buy term plans. If you were to look at Google searches, they're down more than 30%. The overall term acceptance has gone down. People not buying. Which is not great. Actually, this country needs to continuously work. I mean, we don't need a situation like COVID to remind us that we need protection. So we need to be on that journey. But overall, very happy and satisfied with the way we handled.
Thank you. Thank you for this explanation on the importance of delivery systems, importance of not getting into a stereotype model of governance, responding to a challenge, which is, once in a lifetime challenge. Why I started this discussion with COVID is because this is one industry, in my view, which had the strongest connect with this Black Swan event, which changed the way we lived for 2 years. And I thought that it is necessary to start our discussion with this, even though in a normal BFSI summit, COVID will not play a role, but because you guys are the unsung heroes of the entire COVID thing. And may I request the House to give a vote of thank you. Now, I want to sort of start off from where you ended, Mr. Tripathi, and I would ask, and any one of you can answer this question, that if, God forbid, such a calamity or such a crisis were to arise again, would you have tackled the same challenges as you did in a different way? What would be your different way of tackling it? What are the gaps that you felt compromised or undermined your efficacy or effectiveness? Is there something that comes to your mind that, listen, if a similar challenge comes to me, I would look at it in a different way? Is there anything, anybody? Mr. Chog, Mr. Kannan, Mr. Patnaik, Mr. Sharma, Mr. Tripathi?
Yeah, basically, at a human level, we would handle pretty much similar way.
Okay.
But when I look at where we struggled, I think there were the maximum number of struggle across all companies happened at a claims level. We were all capacitized to handle claims which were on a BAU basis. So we suddenly got claims worth 5 years in 1 year. Mm-hmm. So, we definitely struggled actually to process the claims. And equally at the same time, because of the losses, the reinsurance companies became very hawkish in terms of what they wanted us to deploy. So if I were to really correct one big thing, capacitizing properly, automating, and perhaps having clear-cut agreements upfront with reinsurance companies as to how we'll deal with it so that we could process the claims earlier. Because in many of the cases, we took longer to process the claims while we did process, but it is not desirable that we pay the claims late.
Automation meaning what?
I think the overall processes are quite manual. Processes are quite manual in terms of how the claims comes. Then the investigation process. There are investigation process where we go and validate. They are generally field investigations. When COVID is going on, our ability actually to do investigations were fewer. We got into debates with reinsurance firms as to who will settle in whose favor, etc. I think those things could be done better, number one. And number two, overall, the kick-starting this process. So moving from, you remember the 24th of March of 2020. That's when the big lockdown happened. I think all of us came back to action, but it took a bit longer. For some companies like us, it took 3-4 days. For some companies, it took a month. I think to the point Mr. Sharma was making, we have to be prepared like this. Now we are. So if something of that kind were to happen, we will be back to action very, very quickly. So those two come to my mind at the top.
Okay, good. Anybody else would like to respond?
One of the other things that we would probably do differently, I mean, this involves all the people, doing things differently. So one of the things is to increase the awareness. So I think we need to make, more efforts to increase the awareness around insurance.
Fair enough.
We also have to understand, that any kind of insurance, we keep talking about protection products, but any kind of insurance that you take is good enough insurance, as we saw in COVID. For example, a person who takes makes an investment in a ULIP product, so it is a unit-linked insurance product. You should never forget that insurance part of it. That is a major item in that, and it cannot be confused with an investment product, pure investment product. So what happens is that a person took a ULIP plan in 2020 or 2019 and unfortunately died during the COVID period. His family gets 7 times, 10 times the cover. 10 lakh rupees invested brings in 70 lakhs to 1 crore. That is not to be sneezed at. It is a good insurance. So really speaking, any kind of insurance, whether it is credit life, attaching your loans with insurance, or buying ULIPs, or buying traditional products, any kind of insurance is good, and we need to have more and more of that insurance, and that awareness has to be created. There needs to be less noise around the caste system of, protection insurance and T-ROP and things like that. It should be only insurance. You get insured whichever way, whatever is convenient for you and your, your plans for the future. But you have to make sure that everybody is insured, so that one thing is that awareness to be created.
So who should create that awareness?
All of us.
All of us.
The
Great.
insurance industry, of course, has the responsibility, but then a lot of it will depend on the media, on the government agencies to not pull down the industry and try to strengthen the hands by saying, like the regulator has been doing a wonderful job. But it's not only the insurance regulator's job to spread insurance. It is good for the entire country.
Absolutely.
So, all the arms of the government, the media, everybody should be talking in one voice that insurance is good for you.
Absolutely.
And it is good for the economy.
Mr. Kannan, you wanted to say something? Sorry, Mr. Patnaik was... Yeah.
No, I was just agreeing to what Mr. Tripathi and Mr. Sharma were telling. Because all of us know that India has to traverse a long distance to call it a really insured country. I don't want to deal with statistics, but again, that was, as Mr. Tripathi told, after the COVID, the awareness came down. And Mr. Sharma is telling that, okay, any sort of insurance, let people go for it.
Yes.
Because people should be thinking that, yes, part of my spend should be for life insurance in whatever form. Then only the industry can grow to real, that is, expected levels. So those are areas, and these are learning points, because unless a large number of people get insured, then the stresses during situations where this calamity-like situations will be there, it will be very, very difficult.
Okay.
So otherwise, that means the industry is prepared, I think, and they have developed enough capacity.
Absolutely. Mr. Kannan?
As you rightly started off saying, God forbid this situation doesn't happen. I also hope that such crises don't happen. 1 in 100-year event doesn't happen. We hope so. But having said that, I have a slightly different perspective with the way the industry has handled the situation. I think it gives us a lot of confidence of facing any such situations in the future. That's the way I would. Any crisis, it's always the initial phase of the crisis, you don't know the magnitude of crisis. You don't know how you'll have to be nimble to operate the ground realities. And the way we have seen post-global financial crisis, each crisis has been quite different from the previous one. So to that extent, I don't think I can say here that I will have planned for any future crisis ever. So I don't think we can take that approach. What I would say is that taking a lot of confidence from what we have done, I think that is very critical for us. And as Prashant mentioned, we are quite proud of the fact that we are part of this industry having gone through this. So maybe a takeaway is that this resilience of our operations has to be maintained. What do I mean by that? We are probably one of the few industries in the financial services sector who never ran to the regulator for any dispensations during that time. Asset side, pristine balance sheet across. In our case, we have 0 NPA in 22 years of our existence. Several other companies, the overall industry NPA is minuscule. Never wanted any dispensation. Capital, adequate. We didn't go to the regulator asking for more capital during that period of time. And yes, a few companies took losses for a particular quarter or so. But as I said, that's a moment of truth. If life insurance company doesn't make a loss during the period of 100-year pandemic, that means we have not done a good job in terms of coverage. So despite all that, the fact that we have been resilient, sort of takeaway is that let us keep ourselves resilient even going forward. Be it in the capital metrics or asset quality metrics or technology adoption or the sensitivity to pay claims. If you do that job properly, I think crisis can easily be met by the industry. That's the way I would put it.
Fantastic. Mr.
I'll keep it short. I think everybody's just talked about what is an insurance company we all did. And I think as an insurance company, I think it's pretty much tested and the model is all there. I just make one statement around as a corporate. Because not only do we have responsibility to our customers, but to our employees as well. I believe a few of us, including maybe I myself and the company,
Yeah.
took a little bit longer, maybe a weekend longer, to respond.
Oh.
I remember that weekend we lost 7 people, 7 employees. Reading the signals, and we could see the signals coming from France, Europe, China. Reading the signals quickly and implementing quickly, do not debate too much. A crisis has to be dealt differently, even for our employees. There was this little bit in which, were we essential services or were we not essential services? I think that clarity took some time.
Okay.
And in that, I think we all could have been a little better. I would have been 7 employees better.
Thank you. And, thank you for this candor, the frankness, the forthrightness of all of you. To be honest with you, when I started the discussion on COVID, I had not anticipated this kind of candor and forthrightness, and I'm truly proud of conducting this discussion. Thank you once again. We are in a very engaging discussion. We will get into other issues, and it is not a session where we only talk. We would like you to also ask questions. So therefore, keep your questions ready. There's a mic there, and I will not come to you at the end of the discussion, but in between the discussion. So keep your questions ready. And I don't know who is there. Is Ridhima there with the mics or not? Just wanted to keep you, alerted. Mr. Chok, I wanted to come and ask you and, take the round once again like this, but I'll ask you different questions to each of you. Mr. Tripathi talked about the decline in the interest for life insurance policies after COVID was on its way out or was being phased out. Now, that raises the larger question of penetration. We all know that, why penetration is poor and everything. Now, would you recommend to this House what 2 or 3 steps, and after which, if others are willing to offer some extra suggestions on what needs to be done to improve this penetration level, which we all theoretically, economists and non-economists will all agree that India is one of those countries where the penetration level is poor. But what needs to be done from a practitioner point of view? Can you give us 2 or 3 quick suggestions? Then we'll take it forward.
Yeah. See, there is no holy grail, and honestly, there's no clear one answer.
Yeah.
It all works together.
Yeah.
I think more self-governance and regulation, where I fundamentally believe, and I think most people do, that it's not one India, it's a continent almost.
Yeah.
You're talking about 1/5 of the population of the world. And there's at least 6 or 7 Indias. Hence, self-governance is something that is key. And I think the IRDA is very swiftly moving in that direction. And because you can't have a product, see the use and file, all the things that are you seeing now happening are things which perfectly timed and should be done right now. You can't have a product which is just made once a year, made available to all of India, and approved by the regulator. You should leave it to the life insurer to kind of decide. Something in Kerala will be different from Northeast and so on and so forth. So I don't want to get details there. But I think that is the one key takeaway. More digitization and support. So, and again, you can see remnants of that in the regulation. Things like we're seeing Bima Sugam coming in. I think those kind of platforms, honestly, a lot of us wouldn't have thought about. But these are the ones which endorse the sector in a very big way. And with the regulator stepping in and taking a more developmental role versus just, a minute-eyed regulator only, but somebody who's looking at development of the sector. This IRDA, there's a D.
His name suggests.
Yes. I think is a welcome change, and I think we're in the right direction. A lot of this, of course, can be put in a lot of good words, and I can say awareness, I can talk of product structuring, and I can talk of more distribution. Those follow, but I think these two to me are the more critical ones.
That one supplementary, Mr. Chog, you talked about self-governance. Now that is very clearly different from regulation. In many industries, including my own industry, media, we believe that it is better to be self-governed than regulated. Are you suggesting that insurance industry is one where probably the mix of self-governance and regulation needs to be tweaked a bit?
I think it's already being done.
It's already being done.
And I can understand from the, if you just look at history of insurance, 20 years only, right? So our products are 30, 40 years.
Yeah.
So it's just been 20 years since
Liberalization.
the liberalization and the new regulations came alive.
Yeah.
Hence they had to regulate. I think the time is apt. COVID has hit us at a time as well, where we realize that if there is need for the product, people are ready to take more of it. And it's just that you need to be more flexible. You need to approach them. You need to be not having one fit-all kind of an attitude.
Okay.
And that requires a lot more flexibility that comes in. And it comes through self-governance and more directional governance. I think which is what IRD is pretty much doing, if I would say.
Okay, okay. Yeah. Mr. Kannan, if I can come to you and take this question little further and ask you about, there is a lot of talk about the K-shaped recovery in this country, where the upper leg of the K is doing very well, the lower leg of the K is not doing well. So my question to you is the life insurance sector largely focused on the upper leg of the K, if K is a symbolization of the Indian economy, and as a result, the large segment of the economy which is in what I call the Bharat, that has been ignored, and what needs to be done to focus on that lower leg of the K instead of just remaining focused on the upper leg or urban India? I mean, if I'm wrong in any of my postulation, please correct me if that is not a problem. So how do you take the life insurance industry beyond the confines of urban metropolises in India?
Yeah, if
Mr.
you really
Kannan.
look at the country opportunity, I would say that for the long-term viability and thriving of all the companies in the life insurance industry, both sides will have to be focused on. For once, I don't believe that the second part of what you mentioned is really a social issue and not a commercial issue. I believe truly that both sides there is a commercial opportunity for all companies to thrive.
You mean in both the legs?
Sides of K, as you put it.
Yeah.
It is an opportunity for all of us.
Yeah.
So let me illustrate. If you look at LIC's business model as an example, they have always been in a mass affluent kind of a segment, which they have done an admirable job. Then when the private companies came in, when ULIP came in for the first time, I agree with Mr. Sharma that it's not investment, it's investment plus insurance. And people who wanted exposure to market, we could give an insurance and investment combined proposition to them. Probably that could be argued that was targeted more at the affluent segments of the society. Then we had some time back PMJJBY driving the mass segment, and while bank could have been the distributors, but I want to tell all our audience that insurance companies were firmly behind the banks in terms of manufacturing the product to be made available. And that is one area where I believe that the overall awareness also improved. And that is an opportunity. And more recently, the regulator has been talking about a product called Bima Vistar, and to be distributed through Bima Vahaks. By Bima Vistar, what do they mean is that at a customer level, why can't I give a composite product? Why is this differentiation at the customer level between life insurance, general insurance, property insurance, motor insurance, and so on, accident insurance? Give them one unit of full risk cover. To be manufactured, and how does it matter to the customer who is giving it? They want to have a product, and if there is a claim, the company has to pay. So come with a combined proposition at a customer level, which could be manufactured or underwritten by different companies depending on their line of business. And to be distributed through Bima Vahaks. At a Gram Panchayat level, they are talking about predominantly women distributing these products. So I think this is an opportunity we should embrace as an industry, because ultimately, if you have to cover 1 billion population, and that is what IRD has talked about, by 2047, they want no Indian to die without life insurance. If that is there, I would see both sides as a huge opportunity. How to make it profitable, how to do it, our job. In the sense, should we bring technology to bear rather than putting large fixed costs All that is really up to us to do it. But I do believe that both sides there is a huge opportunity. Just to go back to your earlier question on what is to be done, I think we are in a policy sweet spot.
Policy?
Sweet spot.
Okay.
That is how I will characterize the industry now. Because this is a financial services industry, it will remain a regulated entity forever. So that's important because policyholder protection is paramount. But why I say policy sweet spot, on government side, there have been a lot of policy initiatives. In the last budget, you saw foreign ownership getting increased.
Sure.
The Indian-owned regulations were simplified. And more recently, you saw DFS putting out a paper, why not composite license? Why can't we allow insurance companies to operate in allied activities? On the part of IRDA, they have done mission mode activities. They have already relaxed capital certain lines of business. So I think while we have to do our job, right, Prashant rightly said that we have to do our awareness job, we have a huge tailwind in the form of policy sweet spot. I think this is a golden period for the industry going forward. And with that, I'm sure with our efforts and the regulator efforts and the government effort, I think covering every Indian during the Amrit Kal is going to be a reality.
So you are pretty confident and hopeful that the lack of penetration in that underprivileged section of society will be a thing of the past in the next 25 years or so?
I firmly believe so.
Yeah.
And to your point on the governance, self-governance, Tarun's point, I think it's a good point. But what IRD has done here is that they have formed a committee of regulatory review committee. They have told us that why don't you reduce the number of regulations from 70 to single digits. 70 is the number of regulations in the insurance industry. They're saying, why can't you bring it to the single digit? The idea being not to completely deregulate. The idea being to shift from a rule prescriptive based regulation to a principle based regulation. So principles will be there. This is going to be a regulated industry. Principles will be there. And how to implement the principles, there could be a lot of leeway. And a lot of onus will come on the boards and the governance structure of India. That probably is the way to go. Rather than purely being prescriptive to principle-based, not deregulate, but principle-based regulation with a lot of onus on governance coming on the boards and the executive management of the companies. I think it's a very good place to be in.
Absolutely.
Thank you.
Thank you. Thank you, Mr. Kannan, for this excellent proposition you made. Mr. Patnaik, I would be a little naughty here. And my question to you would be, that the industry has seen an opening up for a couple of decades at least, in the real true sense of the term. And yet, there is a skew in the composition or the share of the market size, different players. And there's one giant behemoth which continues to acquire and retain the share of almost 2/3 of the market. And yet there is, as Mr. Kannan rightly pointed out, there's a policy sweet spot. FDI liberalization has happened. LIC has been listed in the market more. How do you think the life insurance industry space will change and respond to this policy sweet spot? And what are the challenges as a huge entity it faces? Mr. Patnaik.
Actually, life insurance business is always a very difficult business. And there should be a regulator and there should be regulations. But what Mr. Kannan said, that the industry has matured over a period of 20 years. We can sit together and find out what are the rules, what are the regulations, that can be dropped at this moment, and we can sort of a self-regulation. Because today, you see, all life insurance companies, they have to be responsible. Gone are the days when any life insurance company, they can act in any manner which will be affecting their reputation or anything else.
Okay.
So, and if somebody asks me that all the 24 companies in the country today, they are all very responsible companies. They are doing a decent job. They built up the life insurance industry. And going forward, all of us know there is huge space for everybody. Okay, Life Insurance Corporation of India has got a lead. It continues the lead because, okay, we continue to do the good practices that we were doing earlier, and we have learned many things from all the players also. And that means, again, that is with good respect to everybody. Because it's an organizational culture. It's an organizational culture that you respect your customers, you respect your agents, respect all the players who are there in the country. and respect the reinsurer. So you can learn from them, because when everybody grows, then only you can grow. If there is not a very vibrant reinsurance industry in the country, then also the life insurance companies get affected.
Okay.
So we know that all of us are first patriots. We're Indians and we desire that India should grow.
Yeah.
And all of us know that without a very vibrant insurance industry, whether it is life, whether it is general, whether it is health, then the country will not grow to that extent. And we have seen, like to give a small example, they call something called sum assured to GDP ratio. So in many countries, it is the number of times is used, and I get my point.
That's right.
But here in India, it's a very small fraction.
Yes.
But India is adopting everything from mobiles to laptops to all the technology, all the good things, what is happening around the world. So it's just a question of time when the best practices of the insurance industry as a whole, whether it's life, whether it's general, whether it is health, people will be adopting all those things in India also.
Okay.
So the insurance market will be growing and growing, and nobody can stop it. And all the companies, they have to, whether in life, general or health, they have to continue to do the good things, and everybody will grow. And there is space for everybody, and it will be only good for the people of India, and also the regulator and the country.
Sure. Mr. Sharma, if I can take the same question to you and ask you that, yes, as Mr. Kannan says, there's a policy sweet spot, and yet it seems, from a lay reading of the numbers, that the opening up of the sector, raising of FDI, policy regulation getting a little easier, has not seen too many insurance applications, companies. As the member IRDI in the morning said that there are just about 19 or 20 applications to be looked at. Now, is there an issue there that this industry is not attracting new players, number one? Number two, is LIC, sitting to your right now, is too big, and the fact of the matter is that it took less time for SBI in the banking space to lose its market share when the banking sector was opened up, whereas LIC India is still holding on. Now, is there a private sector, public sector dynamics which is a little different in the life insurance sector? Maybe I will come to Mr. Chuk on this question. Why don't you first answer it?
Yeah, sure. The first, one of the premises that you've, put forth, that LIC is having one of the largest shares may not be actually true. Like they have a lead of 50 years in the industry. And then we have been there for about 20 years. And, the policy sweet spot, which Mr. Kannan correctly talked about, has just come now. So, what happens is that if you look at the entire structure of the industry, the narrative around insurance was earlier as an instrument of saving with an element of insurance. It was never about insurance first. One of the topics that as Indians we shy away from is death.
Okay.
And this industry depends on people realizing that they are mortal. And you need start the conversation. My agent, when he goes to a customer, he starts a conversation with death. So he has to bring in the topic somewhere. It's a very difficult topic. So he has to tell the person, suppose you are not there, what happens to your family?
Mr. Sharma, I must tell you my personal experience. Insurance agents, particularly from the private sector, no longer talk about your death.
Yeah, my death.
Yeah, exactly.
Yeah,
the language has changed. It's a fascinating thing that myself as a customer I can tell you.
The topic of death has to come. So that's what I'm trying to say.
They don't even use death anymore. They say if you're not there, if I'm not there.
It's a very difficult conversation.
Yeah.
What I'm trying to say is that when you have this kind of an industry, let me come to the topic of this discussion, the UPI moment.
Yeah.
What is missing? Okay. So the awareness is missing, the need is missing. The awareness of the need is missing. Now, when UPI came about, the ground was fertile for a solution. So what happened was, there is a huge migrant worker community, there is a huge BPO workers community, there is a huge population of IT professionals, etc., who are working away from their homes. And then you have this need for transferring the money from one place to another. And there were means, like for example, State Bank of India branches used to be always crowded with a lot of people trying to only transfer money. Then we had the business correspondence, then we had so many things. And what is missing in this piece in insurance? Everything else is there. You have the payment solutions today for making all kinds of payments, the premium payment to maturity payment, claim settlement, everything can be done. Then you have the data. So you have the data, so the account aggregator model is coming for this also. It is already there in the banks. And then all the data around that, even the IT is connected now today, Aadhaar is connected.
So are you saying the UPI moment is arrived?
Yeah, no, that's what I'm saying. The UPI moment has not arrived with a bang in the insurance industry, only because that awareness of the need is not there. And there you need to have a longer term program. It doesn't happen overnight. You simply can't publish in the media that, go and buy insurance and do it. So now, how do you do it? You need to make sure that it is there in the curriculum of schools. You need to make sure that financial planning, inclusion, insurance, these are taught to people from their childhood, so that when by the time they come of an age that they need insurance, they actually don't argue that they don't need insurance. They will just go out and buy it the way they want, and they also understand what they are trying to buy. So that is what I'm trying to say. That element we need to build in, so that we can actually grow. So the market is there. Everybody needs to be insured by 2047. The regulator has very rightly said that we need to insure every Indian by 2047. How will that happen? It will happen because the people will become aware, and you have to create that awareness. Who will create it? We will create it as insurance companies. The media will create it. And then, like I said, the government, the schools, the colleges, they will include it in their curriculum. They will make sure that people realize that insurance is required. It is a necessity instead of an...
So you are saying the UPI moment has not arrived, but awareness, education is required to capitalize on that.
It can arrive.
Yeah. Mr. Tripathi, what would you say? And my question to you is this, that is there something that the question of education and literacy about insurance, is that something that needs to be tackled at an industry level, or society, government, at what level?
Yeah, I agree with, firstly, I agree with Mr. Sharma. The need of insurance is very different from the need of UPI or the need to buy mutual fund, etc. It's very different. It's more covert than overt. Nobody wakes up to say, "Aaj insurance kharid lena."
Sure.
Which means the kind of effort which is required to reach out, propagate, and penetrate will be of a higher order. And then, in that case, we'll have to burn the candle from all sides. Firstly, awareness. Yes, absolutely. It is required, and it will be required over a long period of time. The insurance industry will have to come together. I don't think we have done a great job in terms of creating that awareness. We need to do that. Regulators should do that. Government should do that. Schools, everybody should do that, so that the need is understood. At this point of time, it becomes secondary, because पहले रोजी रोटी हो, उसके बाद insurance हो, ऐसे सोचते हैं. It has to come as a part of the basic need, number one. And number two, I think the big issue that we need to solve is to find a sweet spot of distribution and product combination which can economically, in a robust way, reach out to the lowest.
Yeah.
That is where we have struggled. The industry has actually focused a lot on premium as against sum assured. To Mr. Patnaik's we have not focused on sum assured, and that's why sum assured to GDP ratio is quite
coming
low for
down.
India.
Yeah.
One of the things that we discovered out of COVID is most people were covered, but for very small sum. That was the issue.
Right.
So we need to continue to drive sum assured through a combination of product and distribution vehicle that could reach out in an economical way to the lowest level, which means the current set of products and distributions may not be able to solve that problem. And that will take longer. So those are
the
that I
issues.
like
Okay.
that.
You know, I had promised that I will come to you, the audience, and I'm sorry I was so engaged with this excellent discussion that we are having. If there are any questions, 2 or 3 questions, quick questions, please identify yourself. And if you have this question for one person here, identify his name, and please go ahead quickly.
Hi, sir.
Where's the mic? Yeah, go ahead. Yeah.
Sir, I'm here. Can I go ahead with the question?
Yeah, go ahead.
So, coming out of COVID, looks like the insurance industry has become super efficient, both from acquiring as well as claims processing. Now, from this standpoint, moving forward, looking at the scope of growth with respect to the lower sections of the society that exist, what are the 1 or 2 things that each of you are looking at differently in order to acquire and increase market share from those sections of the society?
Okay.
And are there any existing bottlenecks in improving efficiency further when it comes to both acquiring and claims processing? Both sides.
Okay. We'll take this question also, and then please go ahead.
Yeah, my name is Lavanya June. My question is to Mr. Sharma. He spoke beautifully about the ULIP and the other insurance products. My question to you is, sir, that on one aspect we talk about the awareness, and secondly we are talking about the UPI movement, that we need more awareness. But do we also consider the bottom factors, which are the policy or the clauses and the sub-clauses when it comes to maybe the tenure where which we cannot withdraw the amount? So do we need some reforms on that front as well when we talk about insurance? Because public is aware, like everyone wants to have some kind of insurance because we understand insurance is a risk cover, right? So do you think there needs to be some reforms on that front?
Okay, I've got your question. Mr. Sharma, would you like to respond to it?
See, I'll tell you one thing. Insurance, is kind of a reverse lottery kind of thing. Okay? Everybody pays up small amounts and somebody gets a lottery. If you want everybody to get a lottery and everybody to get back their money if they don't win the lottery, then the lottery fails. Insurance is the reverse kind of thing, where everybody pays the premium and some people get claims when it is required. If you say that those people who actually come to the claim stage will get the claims, but everybody else gets a refund, where is the money going to come from? So basically, like I said, education is the only thing. You need to make sure. It's like, I gave an example of smoking. Everybody says smoking is injurious to health. Okay? Nobody says in schools, nobody teaches that you are free to smoke. Okay? They say that, 18 years or 21 years, whatever is the age, nobody proclaims, even in schools, that, once you are 21, you are free to smoke because you are an adult or whatever. Nobody says that in schools. Same way, the need for insurance, you have to say only one language when you are teaching people in the media, in our own communications. Only thing that you have to say is that everybody should have adequate insurance. And there is no way you can get back your money if you don't have a claim, and then you also get a claim when, unfortunately somebody is dead. So this is the main thing about insurance, and this can happen only through enlightenment, education.
Okay, good. Mr. Chog, you would like to take the question on the market share and reforms that may be needed, maybe 1 or 2 areas which you
I think you are seeing all of that happening. We have a pretty transformed regulator at this point in time, and honestly they're leading from the front. And we in our heydays, maybe a couple of months back or years back, wouldn't have thought that somebody would have come, taken the bull by the horn and started moving the sector in that direction. We got a right Pied Piper here. It is taking us in the right direction. And I think all of those that can anybody talk about in this panel is right happening there. We just paraphrase it and say it differently. So whatever you see in the sector happening from the regulator is happening. And if all of them happen, there will be I won't say UPI moment, but there is a significant upscale of life insurance.
Okay. Thank you, Mr. Chog. Just 3 more questions we'll take. Please go ahead and the mic to be given.
Hi, this is Sharad Chandra.
Can we Yeah. Please stand up, please, if you don't mind.
This is Sharat Chandra.
Yeah.
Thank you for quite enlightening session. My question to the insurance guys are: I see the presentation every quarter, and the persistency ratio remains at the same level. 5 years down the 5 years after the policy is sold, only 60% continues, 40% are surrendered. So what has the insurance industry done in the last few years to improve the persistency ratio? The second thing somebody talked about, awareness. There's something called mutual fund awareness, mutual fund sahi hai. Nobody talks about term plan sahi hai. Thank you.
Okay. Mr. Kannan, would you like to take this question?
Yeah, the first question on persistency, you're absolutely right that the persistency has to be far higher than what it is currently for the customers to get the full benefits. But having said that, I have looked at the data for the industry as well as our own data. Persistency has indeed consistently improved during this last 5-year period. And during COVID, we had a little bit of a dip because of inability of the customers to pay on time, etc. But now the persistency has gone back to better than pre-COVID levels.
Okay.
But it's a continuous focus of the industry. Here, I would like to make differences between the traditional products and the linked product. If you look at the unit-linked products, even if the persistency is low, it doesn't bite the customer.
Yeah.
Because you'll have to return the money, but for some 6,000 rupees or, of the order of magnitude of 1,000 rupees only company can retain. But the customer had to leave the money with the companies for 5 years. Then after that, whatever returns are coming, subject to a minimum of 4% per annum, it has to be returned to the customer. So traditionally, ULIP could be used, and I've seen ULIP persistency to be lesser, but customer doesn't lose, mind you. I want to just make it very clear that customer doesn't lose there. But on the traditional products, it's very important that a customer get to close to a 90% plus persistency to get the full benefits. And that is the work which has been going on. And I believe that if you deconstruct the industry into traditional and ULIP, traditional persistency is far higher than the ULIP persistency in the industry. So that's what I wanted. What is the second question? Second part of the question you had. Yeah, mutual fund sahi hai. We also started off. In fact, sabse pehle life insurance was our term, saying that indirectly saying that even before all that you should be looking at life insurance.
Sabhi se pehle.
Sahi se pehle,
sabse pehle life insurance. Yeah, but we have to work very hard on that. For example, we work with a lot of bank partners to give pre-qualified offers on the term plan. It's a journey, you're right. And even an industry has to give a sustained campaign, not the sporadic campaign like we have done in the past.
That's right.
But I take your point in terms of working hard to bring the awareness like the mutual fund industry.
Okay. Just 2 questions, please.
Hi, I'm Harsh. Excuse me, this side.
Okay.
This side.
Yeah, please go ahead.
I'm Harsh. And
sit down, please.
Someone of you said about the investigation period before the claim.
Yeah.
So what I feel is investigation is some type of field work which the employees have to do. So how did that work in COVID period? Did you had any other alternative to that, or you did something the same as it goes on?
Mr. Tripathi, would you like to answer this question? I'll come to Mr. Patnaik at the end last.
Investigation is not a very regular thing. It is generally done in policies where the policy duration has been very small or the sum assured is very high. In regular, generally for policies which are more than 3 years, we don't do investigation, just go ahead and pay the claims. During the COVID period, it was very hard, and that is why it took a bit longer to do that. However, as an industry, we were nimble, and many a times we took judgment calls to process the claims as soon as possible. But yeah, to your point, it is done typically by our outsourcing partners who will go in the field and verify.
Okay, last question.
If I can just add one point to this, there is one reform that has not happened as yet. Digital registry of deaths. Only 7 states today actually make it very clearly you have to register the deaths. Maharashtra is one of them, right? And then you get your death certificate and all of that. Only 7 states do it in India. If that was to happen, COVID, no COVID, whatever situation, even claim payouts, it gets a lot easier. So I think that's the conviction we need to get and convincing of people.
Go.
Excuse me, sir, I have a question on product innovation.
Okay, go ahead. Last question, yeah.
Thank you so much. My name is Sumit and I'm from Aegis Federal Life Insurance. So just to briefly understand, when we talk about general insurance as an industry, it has moved like sporadically well in terms of product innovation through embedded insurance products as well as micro insurance products across the domain. Versus when we talk about life insurance, it is always a step behind general insurance when it comes to embedded insurance as well as micro insurance products and a few other product innovation as well. So what are your takes around what should be the next steps in terms of innovative product designing as well as followed by distribution?
Okay.
We are talking more about distribution, but we are not talking about product innovation. Ria.
Fair enough. Mr. Patnaik, you have the last word.
Thank you for the question. You see, when we compare with general insurance, so I think general insurance has a lot of needs. So automatically the product innovations will be accordingly manifold. But the life insurance need is limited to deaths, maturities, lifetime benefits, like whether it's ULIPs, whether it's money back. So when you see the range, it gets very limited. So within that range, you can design only. Then you can develop, innovate like children plans, marriage plans, education plans. And I think all insurance companies have some sort of things like that. And if you can suggest something, definitely we can innovate. There is nothing.
Okay.
Because that is what Sarma sir was telling. A lot of awareness, a lot of inputs. So the actuaries are there, the product innovators are there, the computer scientists are there. They are ready to design any product that you desire also. And it can happen. Okay. But I think enough products are there in the industry to cater to each and every need of all Indians. But the fact of the matter is that today also all Indians are not covered, and Indians who are covered, they are not covered adequately.
Okay.
Embedded insurance, you can have it. Suppose many of the, suppose bank products, they have embedded insurance. You have loans, there is embedded insurance. You have savings, there are embedded insurance.
Okay.
You have railway tickets, there is embedded insurance.
Okay, Mr. Sharma, you wanted to have a quick point, please.
Yeah, I just wanted to say, highlight the difference which Mr. Patnaik was making. You know, you have a phone crack, the cover of the phone cracks. You get it, general insurance, you buy it, 20 rupees or something you pay and you get this policy, and the phone cracks and you can claim that, Can't happen with life. So what happens is, this is a longer product. And even the 1-year term life cover doesn't really serve the purpose unless, as you rightly pointed out, the persistency is there. So the persistency has to be there. And that is the difference between life insurance and general insurance. The innovations that come, like for example, travel insurance. When I buy a plane ticket, I can buy travel insurance for that 1.5 days that I will be traveling. I can't buy life insurance for that, I'm not, it's not like that, I buy life insurance only for that. That is covered by accidental cover. Life insurance I need to do for the entire life. So, there is a huge difference between that insurance, health insurance, medical insurance and all that, and life insurance.
Yeah, okay. I think we have to sort of call it a wraps on this session. Thank you very much, everybody. And we had a very engaging discussion. We began with a discussion with COVID. I think the insurance industry sort of really did well in managing the consequences of COVID on the way the claims were disbursed. A lot more challenges remain for the industry. Industry's policy sweet spot, as Mr. Anand rightly pointed out, and as Mr. Patnaik was saying, that the industry will be able to achieve its penetration level, raise it a bit, and probably by 2047, insurance for all would not remain a dream, but will be a reality. With that hope, we end this discussion. Once again, thank you very much, and I'm extremely sorry for having exceeded the time limit. And give them a big hand, please. Thank you.
Thank you, Mr. Bhattacharya and all the insurance luminaries. The fact that despite the lunchtime, most of you are here, I think they've done a stupendously engaging job. So a big round of applause for this round of the conversation, which was on ease of doing business, the UPI moment of life insurance industries. Ladies and gentlemen, our next session is going to start sharp at 2 p.m., which is again going to be a panel discussion led by Mr. A.K. Bhattacharya. And it's going to be on the premise of where to invest, equity, debt and beyond. Again, we have a lot of luminaries from noteworthy companies come and share their perspectives. So I would request you to please be back at sharp 2 p.m. I'll see you on the other side. Offers customizable CRM solutions to companies of all sizes and types. So I'd request you all and urge you all to please explore the exhibit area and the expo happening outside and make sure that you lay your hands on the different products and offerings being laid out there.
REC unleashes the potential of energy. REC
भारत के सभी राज्यों के साथ साथ भारत से बाहर यूके, हांगकांग, यूएई, भूटान, नेपाल, बांग्लादेश और म्यांमार में भी है। आजादी के बाद से पीएनबी में अब तक 9 बैंकों का विलय हो चुका है। बैंक ने बेस्ट प्रैक्टिसेस को अपनाकर एक सुदृढ़ व्यवस्था का विकास किया है, जिससे बैंक के व्यापार को काफी बढ़ावा मिला। सीबीएस की शुरुआत करने वाला पहला बैंक होने के अलावा पीएनबी ने कई नई शुरुआत की है। हाल ही में बैंक ने पीएनबी पीए पर्सनल एडवाइजर लॉन्च किया। ये पीएनबी के सभी डिजिटल एप्लीकेशन पीएनबी वन, एम पासबुक, पीएनबी चीनी, भीम पीएनबी आदि तक पहुंचने का एक अम्ब्रेला एप्लीकेशन है। बैंक ने डिजिटल लेंडिंग सॉल्यूशन पीएनबी लेंस की शुरुआत की, जिससे कि ऋण प्रस्तावों को मंजूरी मिलने में तेजी आ रही है। अब आप घर बैठे वीडियो केवाईसी के साथ ऑनलाइन सेविंग अकाउंट खोल सकते हैं। साथ ही ऑनलाइन जीवन प्रमाण पत्र जमा करने की सुविधा भी उपलब्ध है। देश के विकास में सूक्ष्म, लघु और मध्यम उद्यम एमएसएमई क्षेत्र का बहुत योगदान है और इन उद्यमियों की
REC unleashes the potential of energy. REC funds energy. Funding that catalyzes. Funding that inspires. Funding that transforms. For sustainability and reliability. For investment and development. Adding value every day in every way. This is what our energy is. This is REC.
He's making his investments talk.
All right, folks. Hope you all had a great lunch. Now we move into the 4th session at the Business Standard BFSI Insight Summit, India's largest BFSI summit and event, with pertinent thought leaders, influencers, thinkers, renowned decision makers from the banking and regulatory industries coming together and etching the future of BFSI. Ladies and gentlemen, at this point, we are going to segue and transition into a very meaningful panel discussion, which kind of meaningfully integrates the different topics that we have been discussing since yesterday. The topic is where to invest, equity, debt, and beyond. And to share their perspectives, outlook, and vistas on this very compelling topic, I'd like to invite on stage the following set of luminaries from the investment industries. Beginning with Ms. Lakshmi Iyer, CEO, Investment Advisory, Kotak Investment Advisors. Mr. S. Narain, Chief Investment Officer at ICICI Prudential Mutual Funds. If I can have you on stage, sir. Ladies and gentlemen, I think the post-lunch phenomena is coming on me. Can we give a huge round of applause? Mr. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Mutual Fund. Mr. Rajiv Thakkar, CIO at PPFAS Mutual Funds. Mr. R. Srinivasan, CIO, Equity SBI Mutual Funds. And to maneuver and navigate this conversation, can I request Mr. A.K. Bhattacharya to come on stage. He's the editorial director at Business Standard. Mr. Bhattacharya, over to you.
Thank you. Thank you very much, Ridhima. We have, like in all the previous sessions, we have a wonderful panel here. And Ridhima has already introduced this stellar panel, so to say. And she said that we will discuss where to invest, equity, debt, and beyond. And my obvious question initially was, what is this beyond, you know? And probably we should try to explore what is this beyond. Is there anything beyond equity or debt? We'll come to that later. But you know, this is also, this session is also, in my view, is symptomatic of a major transition of Indian society, Indian economy, Indian style of living, because this is probably the first major meeting that Business Standard is organizing in a physical format. And we had this COVID, which kept us indoors, online, And my obvious first question to all the panelists would be, how has the emergence from COVID-induced a kind of not a setback, but it was definitely something that must have halted all of you in your way of living, way of doing business. How did you look at equity during that time, debt, and if there's anything called beyond, what was that? So my first round of questions probably would be that how did the industry, you are the CEOs of the mutual fund industry, how did you perceive the impact of COVID on your businesses? And the corollary question would be that how do you see the business going forward as your economy emerges from COVID? I will start with, not because she's on my left, but because she's Lakshmi Iyer. So Lakshmi, why don't you start?
Sure. Hi, very good afternoon to each one of you. I was just telling Mr. Bhattacharya, we will figure out, because we had parallel sessions running at the same time. I was just trying to tell him that we do not know which audience will sleep more, because it's the post-lunch session, and anything on finance is not as exciting as what we see in our personal portfolios. So on that note, to your question, I would say there has been a marked change in mindset, in attitude, in behavior, in terms of how we have morphed ourselves very beautifully from, say, a Zoom barabar Zoom to a Zoom barabar Zoom. So that's been the, I just landed this morning from Oman, and मुझे लिटरली लगा कि लंगर बट रहा है, इतना जैसे फ्री में टिकट मिल रहे हो ऐसा लग रहा था, बिकॉज द फ्लाइट वॉज ओवर बुक्ड एंड इट्स नॉट जस्ट ओमान, आई वुड से वेदर इवन इफ इट्स दिल्ली और चेन्नई और बैंगलोर, इट्स अ सिमिलर काइंड ऑफ थिंग. सो आई थिंक दैट्स बिन द बिग चेंज. द सेकेंड चेंज इज I would say the mindset from the fact that nothing is impossible to everything is possible. I think that is the other big change that we have seen in the mindsets. From a global central bank perspective, I think we are morphing very well from a period of injection of steroids to a liposuction stage. So which is a quantitative easing morphing itself to a quantitative tightening. And I hope not that we have to see a similar kind of a scenario again, because that's a very scary situation to be in again. Hopefully, bulk of India is vaccinated. So I think that's been the gradual shift that we've seen in the business mindset, how you thought that virtual dunya hi sabhi hai. So from the real world, real, which is REEL to REAL, real world. I think that's been the change which we are all cherishing. From an investor mindset, I would say on two asset classes specifically, because crypto, I would rather not talk about it, because it's...
let's not talk about that.
Because that's more a 20 minus, which can talk about it. I am 40 plus, so I'd rather not talk about crypto. But I think from an investor mindset standpoint, it was more like on the fixed income side, the question always was, kitna deti hai in terms of mileage? So what kind of returns are likely? And for equity investors, what do I say? You are looking at the numbers, and it's already discussed. The mindset was more like Shiva in Brahmastra, that mera aag se koi rishta hai, main aag se nahi jalta. So that's in a nutshell how I would describe this metamorphosis.
Okay, thank you. As always, peppered with Hindi film songs and Hindi film legends, so to say. Let me turn to Naren and get his point of view on how has the journey been from your industry point of view, and how do you see it going forward?
I think no one would have believed that, when COVID hit, the macro management of India in retrospect turned out to be better than the macro management done by the Western world. So the end result was that inflation in US the numbers have come higher than CPI in India. That happened primarily because of the macro management done in the Western world, because people felt you can print any amount of money, do any amount of fiscal deficit, and inflation won't come. And that turned out to be a completely different experience 2 years later. And if you look at if COVID had come 10 years back or 20 years back, I think the post-COVID situation we would not have managed, because neither would we have had we had a very good telecom system and a very good internet and technology interface. So we could do COVID app, we could do a superb vaccination, put everything into COVID app and do it. So in 2020, if you had asked people, people felt that only China was unaffected and India only was affected. Look at the situation, what people talk about today. So I believe that, and in 2021, people felt that any loss-making company could be listed in India at any price to any set of investors. So finally, as we speak, what we realize is you have to be rational, you have to be logical, and policies also have to be logical and rational. And if you pursue illogical policies, the impact is later, like what US has realized today. And even as investment professionals, what we keep telling our teams is never be irrational, because in 2021, across the world, people invested in loss-making companies. And today, you know what has happened to all of them. And all these new age companies, people said there's no need for profits, all you needed was sales. Today, all those companies, all those investors are now suffering. So I believe that, you know, what the last 2 to 3 years have shown is that you have to believe in technology, but you have to always be rational, you have to be sensible, you have to work things sensibly and continuously keep working hard and not lose sight and then start doing stupid things. And that is the lesson. And it's an endless marathon. So today, if any country pursues macroeconomic policies which are stupid, if as an investment professional I do stupid things, all those impact is not seen today, it is seen much later. And that is why it is imperative that when we are managing other people's money, we have to be always grounded and do the rational things. So at most of the times, what you do rationally today seems illogical today, but the benefit is seen years later. And that's why in 2020, when we used to tell people PSUs are attractive, people used to say, how can anyone make money in PSUs? But 2 years later, now suddenly everyone is asking us, should we not buy PSUs? And today those prices are very, very different from when we used to push them as great investment ideas. And monthly we were asked, how can you have so much percentage of PSU in a portfolio? But today people are asking, should you not add some more PSUs into the portfolio? So that's why I believe rationality changes, views change. And so today when we look at debt also, the situation is different. 2 years back, we never told people to look at debt. Today we tell people to look at debt. So continuously we have to be sensible, logical and rational. I call it SLR.
Just one quick supplementary and a quick answer from you. Has the response from the investing community undergone any change in a significant way in this period? And how do you see that?
I think post-COVID, people were sitting at home, they started to become traders. And the initial timing was fantastic because they picked a time when markets were very cheap. So the first 1.5 years, they made a lot of money. So they all thought that it's very easy to make money.
So they became very savvy initially.
They were savvy, very, very savvy initially.
Okay.
See, unfortunately, I'm a big believer in behavioral finance. So in terms of that belief, I believe that at all points of time, people will get consumed by the greed of fear. So in May 2020, we went out of the way to tell people, look at credit. After a credit event, but no one was willing to look at it. In October 2020, we told people invest in value or PSUs. People said, no, we won't invest. We'll invest in quality at any price. And so I think, at the end of the day, greed and fear and behavioral finance is a problem everywhere in the world. And that is why people invested in so many negative yielding bonds. And everyone thought that yen will keep on depreciating. Suddenly, in the last 2 months, now yen has appreciated 10%. How can a current account surplus country like Japan have a currency which is always depreciating? But people believed in it. Now suddenly they got the shock of their life this week. Okay. So I think that's why I'm a believer that investors don't change. And that is the need for asset allocation, because investors don't change, and that's why asset allocation can bring easy returns to people over a long period of time.
Okay. Rashmi, would you agree with that, or do you have a Hindi song to explain that kind of a...
The problem is investor mindset is heads I win, tails I win.
Yeah.
वो फंडा है, that is number one. And number two is उनको क्या होता है in any asset class.
Yeah.
Tolerance levels are very different. For example, in equities, जोर का झटका जोर से लगता है तो भी the tolerance is very high. They give a long rope and we are seeing that longevity is increasing. लेकिन fixed income में जब जोर का झटका धीरे से होता है तो भी the expectation is that this has to be Teflon coated, which is why accidents जब होते हैं they are not able to. So in the tech index, when you invest in 2000 and till 10 years you get a negative return, capital भी आपका वापस नहीं आता, people are okay to live with it. So I think that mindset has not really changed. And that is probably the reason why you're seeing the gush of flows into equities still very rock solid. If you look at the
absolutely.
Industry retail data, whether it's retail, etc. And if you see the converse is true or the reverse is true for fixed income, where if you look at the X of overnight category or liquid for that matter, the category flows are net negative. That's because जो झटका होता है ना, वो variation, it depends, who is giving you that झटका.
Okay.
So if Big B gives you a flop, you are willing to tolerate that because वो बोलते हैं कि यार ठीक है यार, form is temporary, class is permanent. Okay. लेकिन अगर new upcoming कोई सितारा आके एक flop दे देता है, the tolerance is very poor.
Okay, let me turn to Mahesh. What's your takeaway on what happened during COVID, both from the mutual funds point of view as well as from the investors' point of view?
Yeah. So I think I will not repeat what Naren has said, but I think if you look at it as an economy, India has actually emerged much stronger out of this COVID period, and that's the biggest accomplishment I see for India because, I think the reforms what we had done pre-COVID, right, be it in the banking and financial services sector, the real estate sector, the GST reforms, all that actually prepared us, in this period. And when things started to recover, and I must give credit to our policymakers, both the RBI as well as the finance ministry in terms of they didn't really try to, while they want to stimulate economy, but in a very measured way. And that's why our recovery has been slow and steady, but without creating any kind of bubbles. And I think the overall, I think we were very much digital ready. I think, again, the reform, the whole Jan Dhan and all these opening of bank accounts helped in this period so that the economy was not disrupted. And same for our mutual fund industry also. I think the movement, adoption of digital and moving online was very seamless. And actually that led to explosion in terms of the growth, especially for new investors. If you look at in the last 2 years since COVID, the number of new investors who have come into the industry is huge than what we have done. The demat accounts, what we added, is more than what we did, cumulatively till date. And that has actually helped the industry to grow. And as an economy, I would say, because of the disruptions what we saw during COVID, I think India is now emerging as a kind of another superpower because people have realized the geopolitics, which are being there. India is only place which is neutral in that sense. And the China +1 policy, which was people were looking at, that only got accelerated after COVID. And that should benefit a lot of Indian companies going forward. And I think that would take India, economy, if you look at in this whole period now, India's growth is much stable, much more sure, and likely to be steady, even when next year we are looking at global economy getting into a recession. So that's, what India as an economy has really benefited out of the COVID. And I think with the whole digital ecosystem of India, India has got a large talent pool of IT professionals.
I think that really flourished in this period because we saw that a lot of companies globally wanted to move towards digital, and India could really supply with that manpower. And that, to large extent, benefited the economy. And adoption of digital in this period for many corporates, okay, we've seen has been much faster. And that makes our country, I think, much more future ready and to really go on the next transformation, okay, what we can see in the next decade or so.
Okay, I just wanted to check with you as a supplementary. Has the demographic dividend, so to say, has played to the strength of your industry, or has it been a problem in post-COVID or during COVID?
So I would say actually it's benefited because as I talked about, the number of investors, okay, now who have come in, the number of increase in the mutual fund folios, what we have seen, a lot of young people, okay, millennials are also now looking at because they are more tech savvy, right? Mm-hmm. And digital platforms which have come in made it easier for them to really access some of these products. They might not be large investors, but they have come in early, which is good because when you get these, catch them at the early phase and they can be there in the long-term journey in terms of creating wealth. So, yeah, I would say that it has
helped.
Helped, yes.
Okay, Srinivasan, what's your take on the COVID and how the mutual fund industry has responded to it and investors?
Whatever these guys have said. But from a market perspective, two things are important, right? Mm-hmm. Earnings and valuations.
Yeah.
Earnings have been the best into COVID. So 2020 to 22 earnings have been rocking. Way better than what we saw between 2014 to 2020, in fact, right? Due to various reasons, which I will not get into. Valuations have also been on the up. I mean, valuations are much higher than what they were. Obviously, partly due to the significant easing that we saw not only in India but across the world. So rates were down. They've gone up obviously recently, but generally that led to an uptick in terms of price to earnings multiple.
Correct.
And I also presume that valuations have gone higher because you're kind of seeing a savings glut, especially in the kind of investor population that we cater to. Now, this investor population has specifically benefited from COVID. So people like you and me, right?
Yeah.
COVID has been, I mean, apart from the personal losses that we've seen, from a monetary perspective, COVID has been a huge beneficiary because we got our salaries. Most of us got our increments. We didn't spend at all. Our spend went down significantly and our net savings jumped. Plus the asset pool that we had gave you a huge wealth effect. You're seeing all that in the form of revenge shopping and revenge travel right now. So I think I wouldn't have imagined this when you were kind of into COVID or even when the concern on COVID started to decline. But it's been phenomenal.
Okay, so that's a positive you see.
It's been a huge positive if you ask me, yeah.
Okay.
I mean, not COVID.
And so now obviously, there's the outcome of that. As a result, the way the investors have. Yeah, that's right. Let me turn to Rajiv. What's your take on this issue?
So I think not just COVID, even before that, whenever there has been any problem, the investor mindset has been buy the dip, and the central bank response has been throw money at it, cut liquidity, or increase liquidity, cut interest rates. Starting from late 90s Y2K issue, pump liquidity, cut interest rates. Global financial crisis, same thing. COVID medical problems, whether it's a medical problem, financial problem, or a technology problem, it's been pumping in liquidity, which worked like clockwork in 2000 to 2021, 22, 2020 to 2021. The issue now is that they are facing consequences of that. So earlier it was something they could do without repercussions in terms of rising inflation or things like that. This time they don't have that option. Now they seem to be committed to providing real interest rates to savers and not cut interest rates at the slightest pretext. Given that, I think the situation today is that you have a whole set of people who haven't seen a sustained period of equity downturn. People on this panel are old enough to have seen 92 to 2003, 11-year period where indices went nowhere. Audience, a lot of people may have seen only upward trending markets, maybe maximum we have a 6-month or 1-year drawdown and things are back to normal.
Yeah.
So from that perspective, I think my fear is that people are probably over heavy on equities. I don't probably share the optimism of Lakshmi. I hope she is right. But I don't think that people are here for the long haul. Even today, as we speak, net inflows into equities are lower than the monthly SIP inflows. So that means while SIP inflows are coming in, people are also redeeming. And this is just 1 year of flattish kind of markets overall. So in a slightly longer tenure, choppy or sideways markets, people may lose faith in equity. And I think people who don't have the risk appetite or the tenure should really look at their asset allocation.
So are you saying it because of the interest rate firming up, so therefore the equity, is that what you are saying?
The small point that I'm making is people have been accustomed to central banks bailing out markets. That may not hold true in the future. That is one. Second is people have been accustomed to dips being recovered very, very quickly and have not seen an extended period of a downward or a sideways market, which is something that concerns me a bit.
Okay. Lakshmi would like to respond to, it was a direct attack on you, you know?
No, there is no attack. We are all in for, wealth creation. I think there is no two ways that equities is. So I don't think there is a divergent thought. The only one thing we need to keep in mind is at a time where X of SIPs, the lump sum flows have tapered down. So if you see X of equity, X of SIP flows, the industry was actually negative. We should also appreciate that at that time, the AIF folios or additions are actually going up. So which means people are either diverting money from their some bit of pool into, say, listed equities, but in the AIF space, or maybe in the private equity, or a combination of either or. There is no cause-effect relationship, so you really can't, determine whether it is actually attributed to that. Gold is actually seeing a negative net sales again month on month for the last 2-3 months. So anecdotally, price elasticity of gold is very high. So on a rupee basis, gold has actually touched a lifetime high. So that is the reason probably you're seeing some bit of redemptions. Bulk of it is attributed, I agree, to the rupee depreciation. So I think what I was trying to communicate is that the tolerance, because the mindset is, and especially to be fair, in the last maybe 2.5 years, the retail investor has barely seen a negative return in equities. It is always like tic-tac-toe and there you go. So that Midas touch is kind of playing on the investor mind, so much so that even if you took anything in the CBM category, now I'm sure the audience doesn't know what is CBM category. This is just this is just a colloquial thing which we discuss in our dealing room. CBM is basically Chor Bani More. So Chor Bani More category is dancing right now and it's not even monsoon. So yes, it is time to be cautious. So I echo the concern that there is a marked, I would say, high-ended optimism which the retailers have pumped into the market. Going forward in the next 12 months, is it going to be a bumpy ride? The answer is probably yes. It's not going to be slam dunk that there is going to be money short on the table. And with the kind of, the medical crisis which is resurfacing, we don't know whether it is just like a green shoot effect or literal. One needs to be guarded. There is no two ways about it. But in general, it's been our experience and observation that you give a slightly longer rope to the asset class called equities, because equities always is shouting that rishte mein to hum tumhare baap lagte hain, naam hai equities. and fixed income is always shouting to the investor ki abhi na jao chhodkar ki dil abhi bhara nahi.
There's nothing to beat you on that. Naren, why is this, there is some wariness which is getting reflected on the equity side. As I think both Lakshmi and even Rajiv, Srinivasan, Mahesh pointed out, there is enthusiasm about equity, but there is a sense of concern. Would you share that concern, and why and how? And investors need to respond to that concern over investments in equity?
I think for about 2 to 3 years, I think there was no need for money in the debt market or deposit market. So if you look at the data today, the last 1 year, credit growth has been some 19 lakh crores.
Yes.
Deposit growth is only about 15 lakh crores. And government may have needed something like 5 lakh crores from the banking system for the government securities market. So the need for money was 24 lakh crores and the deposits have grown by only 15 lakh crores. So I think after a long time, the need for money in the deposit market has come. And you would have seen multiple rate hikes on the part of banks in the deposit market also recently. So I think that is the main factor, because for a long period of time, banks were fund flush. The core liquidity in the economy was very high. I think that also has played a role rather than anything negative on equity. I would say that a lot of system participants are saying, give me money in deposits. Even from a market point of view, we have been telling people invest in debt mutual funds, because you go back 2 years back, an overnight fund would have given you 3%. And I'm taking overnight because that's the most certain, and which we can talk more easily about from a riskometer point of view. Today, the same overnight fund will give you 6%. And so you invest for 1 day, it gives you 6%. So that kind of a framework happens at this point of time, that even on an overnight return has gone up from 3% to 6% at this point of time. So I think debt is becoming a much more structural asset class at this point of time, because from 2008 to 2021, you had 2 printing presses in Washington and Brussels.
Yeah.
Both those printing presses are closed. And this week, even the Tokyo printing press is threatening to close down.
Yeah.
So if all the printing presses are closed, then you have to depend on local savings for local needs of money. Because if all the printing presses in the world for printing money are closed, you have to depend on local. So I think due to that, debt becomes a structural asset class. And if debt becomes a structural asset class, we finally have competition for equity. Because for 13 years, you had no competition for equity because you had 3 printing presses. And that, I think, is more the reason rather than anything that has happened in equity market. So I would say it's more the attractiveness of debt as a structural asset class, because no one now believes that Fed is going to start printing money, which means that Washington is not going to print money. So that's why I believe is the situation.
Okay, but let me come to you, Mahesh. Would you agree? I mean, is there anything more that is at play which has made the perspective on equity a little clouded?
So I think, hello. Yeah, I think the interest rates going up.
Yeah, we can hear you.
Okay. That has been one of the reasons, because if you look at last few years with low interest rates, everything moved into equity, right? We saw large inflows now, as Naren mentioned. Okay, now debt is an alternative which you can look at, right? Because the risk reward, if you look at in debt on a near-term basis, is looking fairly well balanced. So that now becomes an alternative for investors to look at. But I think other concern, which is there is because a lot of narrative now talking about how the increase in interest rates is likely to impact the global economy, right? People are talking about US getting into recession. Europe is already into recession, right? With quarter-on-quarter GDP growth of negative. And to what extent that pain will be. I think that is still uncertain, because whether it will be only a couple of quarters and then it will bounce back, or it will be slightly longer period, and what impact it will have on the corporate earnings growth. I think that is an uncertain period which I think we are getting into. And I think that is weighing back on the minds. And not only here, but global investors also. And we've seen that markets have been a kind of in a corrective phase. We haven't seen that much of an impact because our growth to some extent has been more resilient, and we are not seeing any major downgrade. But I think that is an uncertain period we are getting into the next calendar year, which I think investors are slightly worried about, and the whole narrative about slowdown is slowly gaining momentum. So I think that probably is something which investors would be worried about, I guess, and that's why we've seen some smart money is moving out, right? So when we see, while SIP is continuing because SIP is more retail money coming in, but it's more of a tactical movement. I still believe that this is a market, okay, in the correction, okay, what happens. I think structural story for India is very, very strong. So say that correction, whenever it happens because of these concerns, will be a good opportunity for somebody to buy into equity with a favorable risk reward, because at the current juncture, we believe that the risk reward is very well balanced, right? So one should also look at debt as a part of an allocation if you're putting in money for the next 1 or 2 years. Obviously, longer term equity still would be a great investment. So I think that shift is something which I think you would see in the coming quarters, asset class shift.
Srinivasan, what's your take on this equity versus debt right now? You know, the three gentlemen, the lady and the two gentlemen talked about how the equations is slightly different, you know.
So let me start with a disclaimer. 100% of my money is in equity. Even incremental savings go there.
Okay.
Having said that, our house view is negative equity. So
house view is?
Negative equity.
Negative equity.
Yeah, so on a 50-50 equity debt benchmark, our model says, which is a fundamental model, that you should be underweight 20% equity. And we're negative on equity because equity valuations are way too high. When you look at earnings, even adjusted for bond deals, for example, equity valuations are way too high. And the equity risk premium, basically the spread that you get on equity or expected return on equity is way lower compared to what you're getting today on sovereign debt. So on a short-term basis, say 1 to 3 years, you should be more into debt than equity. That's
okay. If I can ask you as a supplementary, why are you 20% negative on equity? What are the reasons that you have cited?
Okay, so we run a model, fundamental model, which is based on 3 pillars: earnings, valuation, and sentiment. Right. So on the earnings side, we are seeing the macro drivers are positive for earnings. Even on a micro level, earnings have been very buoyant, like I said, for the last couple of years. And we expect earnings growth to continue. So this year, I think we're expecting 12-13%, but we started off with 18%. So while I say earnings are positive, there are also downgrades on a quarterly basis. But earnings, broadly, the trend is positive. On valuations, we are somewhere closer to the 85th, 87th percentile. When you look at when you look at a forward P ratio, you look at a price to book, we look at something called a Schiller P bond deal spread. Basically, Schiller P accounts for earnings cyclicality, and you take out bond deals because P's typically go up when bond deals are lower, right? Now there is a headwind there because bond deals are going up.
Okay.
So there we are closer to the 85th or 87th percentile. You want to be lower than the 50th percentile. So our expected, I don't want to put an expected number. We kind of regress this to 3-year forward returns. But if I kind of put out a 3-year forward return, it kind of says that is the return that we expect. It is only indicative. So that spread that we get on that expected return compared to what you're getting on sovereign paper today is just not good enough from an equity risk premium perspective.
That's right. That's right. Rajiv, where are you on this debt versus equity? You have already shown your preferences, but why don't you elaborate on that? Why is equity, you are slightly low on equity? Yeah.
Yeah, I started on this point, so let me diverge a bit now.
Yeah.
So we have all heard the story about a person who was 6 feet tall, drowning in the river, which was on an average 3 feet deep, right? Because averages hide a lot of things. At some places, it could be maybe 20 feet deep.
Yeah.
So I'll expand on the point that Naren made. He spoke about quality at any price kind of companies, and he spoke about loss-making companies.
Yeah.
In the last 20 odd years, I've seen individual quality companies, which were quality companies even 20 years back, which continue to be quality companies today. These in 2003 would trade at 10, 11, 12 times earnings. Today they are trading at 80, 90 and 100 times earnings. So what 2 decades of very, very low interest rates have done is, and Buffett has also spoken about this, at one point in time, a bird in the hand was worth 2 in a bush. With 0 and negative interest rates, birds are at the same value whether it's coming 1 year from now or 20 years from now. So that has, I think, fundamentally changed now with the rising rate scenario. I think if not a price correction, we will see significant time correction in some of the...
Significant?
Time correction, where stock prices go nowhere and earnings have to catch up. So I think that is a real possibility to me in the so-called quality bucket and the loss-making bucket. At the same time, I think there are pockets where one is seeing value on an absolute basis and even a relative basis compared to their own past histories. So just to name a sector, financials, for example, are coming with a very clean balance sheet now and are looking at credit growth and spreads and things like that. So I think averages will hide a lot of things. One has to go beyond the averages.
Okay. Are there any exogenous factors that you are not taking into account which can change this, your assessment of this?
I think exogenous will be this whole overweight equity thing that people are on. I think 1 year money, 2 year money should not be fundamentally in equity, which people will learn the hard way in the days to come.
Okay. Srinivasan, let me come to you because you are most categorical about equity not being your favored and
But I
preferred.
also said 100% of my money is there.
I know that. I know that. A lot of people are expecting many things from the budget. Is there anything in the budget that you expecting or you think could change this thesis of yours? What could change the outlook on this front from the budget?
Nothing at all.
Nothing?
Yeah.
The basic fundamentals remain the same?
Yeah. I'm pretty bullish on the growth story of India. But yeah, nothing that I expect that makes equity more positive.
Or less positive?
Yeah, I hope they don't increase capital gains.
So capital gains is something that worries you?
Yeah. I think logically they should. Maybe they would, but I don't know.
You're not worried about the borrowing levels, interest rates still continuing to go up?
See, I'm not an expert on macro here, so I think this question is better taken by others. But yeah, our view on interest rates, we of course have our house view, that interest rates may not go up significantly higher from where we are right now because we're seeing a pivot. And you've seen what RBI is also telling you. So we're not expecting interest rates to go up significantly. Is that a tail risk? For sure. But not what you're expecting on a higher probability base.
I understand, yeah. Is there anybody, three of you would like to comment on this budget changing the perception on the equity versus debt scenario? Yeah, please go ahead, whatever.
I don't see any material. Budgets really don't make that big. We make a lot out of it. But finally, we see that whatever direction the government has set in the last budget, I think in terms of development, infrastructure, and that will continue. But we don't see any major impact in terms of, say, interest rates going up. I think at the end of the year, government tries to manage, your overall expenditure in terms of what they have planned. Revenues have been fairly strong, because of GST collections and others have actually surpassed. So there is room for the government to really manage some of the expenditure which has gone higher because of higher fuel oil prices, the fertilizer subsidy. So it's to be fairly well manageable. We know the government is going in a path for also tighter faster fiscal consolidation. So I think growth would still be the prerogative because getting into the elections 2 years down the line, they would want to see the economy in a good shape. So I don't see anything majorly negative coming in the budget except probably from taxation perspective.
Okay. Naren, you are a behavior finance person. Do you think something the budget may happen or may not happen which affects the perspective on debt and equity?
We've seen 90s budget. At that point of time, tax rate started very high and moved downwards. So, we are still, the entire country, maybe media is still thinking of 90s. But unfortunately, there's no scope for taxes to go down like what happened in 90s. That every year we can hope that in the budget tax rates can go down. That scope doesn't exist. Obviously, I would say that there is, in the last 5 to 7 years, the amount of money which comes into equity has gone up. And see, if you look at the net amount of money that is available in debt has gone down, which is, I don't look at it on the basis of money which is collected by bank. The amount of money that is required by the government for fiscal and state government for fiscal, etc., that has gone down. So somewhere we need to incentivize financial savings in debt now. Okay. Over a period, we have, so if that something happens there, like for example, if you reduce long-term period for debt, that will be useful because I think money will come into debt.
Okay, and that's one positive thing.
That would be a positive if you reduce that, because finally at the end of the day, today, I mean, in this entire period, I have not seen in this audience the number of people who would have invested in debt mutual funds will be much lower than the number of people who have invested in equity mutual funds. So I would say that if you reduce the long-term period from 3 years to 2 years, I'm sure that the number of people will go up. So that's what we would like to see. Whether it will happen, not happen, that's not. But I don't think the government has some magic in a budget today that they can go and change. There is no magic budget like 90s. There is no customs duty of 40% which can be brought down to 10% or something like that.
350% brought down.
All that is not there. So let's accept that the government doesn't have it. Can we reduce long-term from debt from 3 years to 2 years? Yes, in debt. Yes, certainly that's possible. Can they do it? Yes. Will it have big impact on collections? No. So maybe they can consider that. That's all.
Okay. Lakshmi, your take on that? Budget being irrelevant? I mean, Naren has made a very fundamental point, and I entirely agree with you. It's by and large, it's been overrated right now, to be honest. Yeah.
No, so certain contours are laid down in the budget more from a policy making perspective, and it just so happens that budget happens to be the starting month or the period of Valentine. So what I'm trying to say is that it doesn't have to change your love for the asset class.
Okay.
You can fall in love with the budget, but does it really change your outlook towards an asset class? Very, very unlikely. It has to be more the fundamentals. Yes, you can draw some cues in terms of certain categories. And to Naren's point, if you look at India's structure of asset class capital, I would say the taxation structure, fixed income is taxed at 3 years being long term, whereas equity is at one year long term. And the mindset of the investor to stay around for 3 years right now is only for the fear, yaar, mera tax katega. So that's the mindset. So yes, you can. There is a case to rationalize that. Will it happen in the B day, V day, after that day? I really don't know. But I think time has come that we try to rationalize and route some savings across from what is required to what is right from an investor standpoint. We have seen consistently that asset classes deliver returns in cycles and in patches, and it is agnostic of a monetary policy or agnostic of a budget. So fundamentally, if you have your asset allocation right, to Asan's point, he said he might be, or the house view might be negative on equities. But if you are looking at wealth creation, which is true for most of us sitting in this room, wo nimbu pani peene se to wo nahi hoga. You need some steroids, you need some caffeine, and that is going to come out of equities without a doubt. But near term, those glitches will be there. I was dune bashing in the deserts a couple of days back, and to do the terrain of the sands, you need to deflate the tires. So as expectations of returns in an asset class deflates, you are slightly more pragmatic towards making an investment decision. It cannot be the flavor of the season or flavor of the week. Aaj kaun sa chalega, aaj ka kya flavor hai? That's not going to work. That mentality is good to make some quick bucks to be able to, fund your next date. But beyond that, I think it is the fundamentals which have to play. So it is B day or V day or MPC day. I don't think that should be your guiding principle.
Okay, wonderful. Completely demystified budget, deglamorized budget. Let me turn to the final round before we take questions from the audience. Is there anything that needs to be, let me start with Lakshmi, anything that needs to be done on the regulation front? There's a lot of talk about how regulation has to be soft and yet vigilant. Your take on that?
So I think from a regulatory standpoint, enough is already under the works. We have already seen quite a bit of things getting streamlined. In the name of transparency, for example, it could put X-ray to shame, for example. So that's the kind of transparency that it provides to every stakeholder, whether it's a manufacturer, whether it is the investor, or whether it is the channel partner. So I think that transparency in itself is a great or a tall statement to boast about and take home. There are a lot of best practices which probably the rest of the world is trying to cut copy-paste from India in terms of how to really conduct itself. And equally important for us as regulation in India is to try to pick up some of the creative, I would say, product positioning. As a case in point, a lot can be done on that front, whether it's on the leverage side, whether it is on derivative side. We recently saw, AIFs being allowed to do credit default swaps. So I think these are some of the mutual give and take that regulatory authorities can do, say, between India and the rest of the world. We learn some and we take some.
Sure. Naren?
Clearly, I think we don't have a vibrant debt market. And I don't know why we have not managed to create it. We managed to create such a beautiful equity market, derivatives market. The depository system has also been fantastic. Why we have not managed to create it over a period of time is something for...
That what is you?
I mean, it should be as easy. Today, it's so easy to sell stock worth 25,000 rupees. But if you bought there's no way you can buy debt of 25,000 rupees and sell debt of 25,000 rupees other than through mutual funds. Of course, that's good for mutual funds. But otherwise, I would say that the fact that there's no easy debt market, I would say something has to be created so that it's very easy to do it the way BSE and NSE has managed to create a beautiful equity market. We need to create a market which is easy in debt as well.
Is the government responsible for it, in the sense that government itself is such a big borrower that probably, the need for a vibrant debt market?
Why it has not happened, something which baffles me, because why this has not happened. Maybe I would say that the whole STT mechanism which got created in way back led to a very, very good nationwide market, and the exemptions given for tax based on STT was responsible for creating united market through stock exchanges. So maybe we need some very, very small STT and some tax concessions in trading debt so that people start trading debt.
Oh, that's an interesting thought, actually. Mahesh, what are your thoughts? I mean, why hasn't we developed a vibrant debt market? And that actually is something that the doctor has ordered for the Indian economy for quite a few years, that you need to have larger avenues for financing, and if you have a proper debt market, you would. So why do you think it has not happened, and what needs to be done?
Yeah, I don't know. I mean, we have been trying. I've been talking about this for a long period of time. Okay, we have seen now that there have been index funds, okay, which have come in on the debt side. Okay, which is in a way trying to get participation over there on the debt side, which we've seen regulation on that front coming in, and some of the funds have come in. So we've seen to some extent progress on that front. But otherwise, it's been a tall cry in terms of trying to, from the industry side, okay, to make it more, because how do you provide liquidity over there, right? So you need to have more liquidity in the debt market, then only you will see retail participation come through. But I would say that we need to work closely. That's an area where regulation probably can do more on that front. I think equity is well penetrated. I think you need not sell equities now, right? It's automatic, right? On debt, I think we need to incentive either through some taxation, provide more liquidity, come with other products and instruments, okay, which will be easier for retail investors to participate.
No, sorry, I have no views on that. I have no views on that. I am an equity CIO here.
I have plenty of views to make up for Srinivasan not answering. Probably this is not the forum, but quickly I'll make a few points. One thing is government itself competes with its own bonds.
That's what the point I was making.
You have RBI floating rate bonds, which have no interest rate risk in that sense. You have the now, of course, rates are comparable between traded government debt and the small savings rate. But otherwise, small savings rates were 1.5% higher than traded bonds. So why would anyone buy those traded bonds where there's no tax incentive plus asset management fees will be there? So that's the other point. Third quick point is, I think you cannot have high grade corporate bond market, a liquid market, without having a highly liquid distressed debt market, which seems ironical, but people like Howard Marks and all have made their mark in distressed debt. Today, if someone defaults and the market is going to disappear, then there will be no market below the AAA market.
That's right.
And to Naren's point of why is it not easy to buy and sell small quantities of treasury bills, I think in equities they made one single change which solved this problem. They removed the concept of a minimum lot. So you can buy and sell one share on the
they have not done it.
On the platform in debt market. You can put minimum fill 5 crores or minimum fill 25 crores. Obviously, you don't have liquidity. If you convert that to equity, I think the treasury bill and government bond market on NDS for liquidity papers at least, it's quite active.
Essentially, I mean, without your specifically saying it, that the government needs to mend its ways as far as borrowing is concerned. Fiscal deficit must come down, which probably...
So we are confused between wanting a liquid market versus protecting the interest of
the
savers, senior citizens, whoever. And I'm not saying one way or the other, but we can have only one and not both.
Sure, absolutely. I think let's get some questions in. Yes, please go ahead.
Hello.
Yeah.
Good afternoon, gentlemen. Hi, ma'am. So, sir, like Srinivasan sir spoke, like he's really bullish on equity. So, I do resonate with the idea that mutual funds sahi hai, and to everybody else here, mutual funds are subjected to market risk. Please read all the scheme-related documents carefully. So, the question here being, so I do understand that there are certain risks associated with it, and now why I'm asking you this particular question is, so I read this recent, regulation that came out from SEBI where it says that asset managers must have at least 20% of their assets allocated to, in the game. They should have their skin in the game. And now the question here is, so when they have their skin in the game, what is the outcome of it? Because I see two sides to this. It is either that now that they have their own stakes in the game, they work harder and they try to bring, a more standardized...
Can you come to your question, please? Your question, please.
Yeah, that's my question.
Yeah.
So I do understand, since now they have their skin in the game, they could either do two things. One is either now that they have their skin in the game, they try to standardize the CAGR, bring out better results, or now that they have their skin in the game, they try to go all out and make rash decisions, and the end retail investor might not get good results. So how do you think it would basically pan out?
Yeah. Who can take this question?
I can have a go.
Yeah, sure.
If a substantial portion of your net worth is in the scheme, there's no reason to be reckless. In fact, it disincentivizes excess risk taking. Our behavior has been the same before and after the circular, as I would think most professionals would behave the same way, whether that circular is there or not. I don't think it changes things too meaningfully.
I think it's a little unfair to the debt guys. I'm equity, my money was always in equity in my funds. But the debt guys who manage overnight, if they have to put their money in overnight because they have to show skin in the game, I think it's outright stupid.
Yeah.
So this regulation, there's a lot to say about this regulation, but I won't.
Yeah, we have 3-year lock-in on our liquid fund investments. So there you go.
That's a bail. There is a boon and a bail.
So, sorry, coming in on that, I mean, you take your mic. Yeah.
Sorry.
You said something very interesting. Yeah, go ahead.
No, I just said, see, what is skin in the game? The concept is simple. So when people invest, right, it is actually pretty common in private equity, where the key personal is it's an aspect when you analyze, when you want to put money in a fund, you kind of ensure that the key personal stay. If they leave, you have an option to quit. And you also want to check how much money do they have in their own fund, right? It is kind of, in our context, it is a little, I don't think the regulation is fair across all market participants.
Sure. Okay. Yeah. You wanted to add to it? No?
It's just that, if you are investing a good chunk of your money and, 50% of the industry or 40% of the industry is liquid fund, which has an AUM of 5 lakh crore, and you're investing at 6.5, and imagine you're a leveraged investor and the mortgage rates just crossed 8%, then you are running a negative carry on your personal portfolio. That's the only small chink in the armor. Baki sab badhiya hai.
Okay, good. Next, who?
For equity guys who are well paid, it's fine. For all others, it's a little.
Yeah, okay. Who is? Yeah.
Sir.
Yeah, they're first.
Yes, sir.
Yeah, go ahead.
I'm Hemant Joshi. I'm in the equity industry 1st February 1988. Lots of things I have seen. India is growing, but today we have only not more than 10 crore limit account. Your take, please.
10 crore demat accounts.
आप देंगे ये सवाल?
No, but actually, if you look at the addressable market for many things in India, they're all stuck. If you look at the number of two-wheelers in India, it's stuck. I think if you read R.C. Bhargava's interview in car industry, it is stuck. You look at many things, everything is stuck. Not more than 10 crore. 10 crore is a decent number. I don't think we have 10 crore in many things.
Yeah.
That is the reality of India. The 10 crore is not a bad number.
Is a hell of a lot.
And look at the compounding that's happening in that phase, right? The more you're realizing, you had Demon as the first case, then you had COVID as the next phase. So there are multiple catalysts which are accentuating that process. So, the addressable population itself is not that 1.3 or 1.4 billion that you're talking about. That needs to be excluded. And then if you look at the number, and the stock was low. So as and when the base grows, if you start compounding at this base, that is the true metal. And with the demographic population realizing that this is the true steroid wealth creation. See, nobody is retiring at 60, or most of them are not retiring at 60 now. With the stress levels and the kind of thing, the new age is probably 50 or sub 50. So I think for that, the accentuation of wealth creation has to happen, and there is no two ways. That's getting realized, and that's reflecting in the demat accounts.
Think in terms of households. So population divided by, say, 4 or 5, and then there is the below poverty line or close to poverty line, and then this number is actually pretty good.
My supplementary question is, where other Indian cities are investing the money? Equity is a wealth creation, but people are not investing. What is the take for the industry? What industry should take care for the?
I totally agree, and I think we've been speaking internally about some kind of a broader plan where I think we don't have time right now.
No,
but I'm saying
we can discuss it offline.
To improve penetration.
Thank you very much.
Thank you. One last question from anybody? Hello. Yeah, please go ahead. Where is your mic? Mic, please. Yeah.
Hello.
Yeah.
Hello.
Identify yourself and.
Hello. I am a.
Yeah.
So who?
Extreme left.
Yeah, right. Oh, okay. Okay, go ahead. You go ahead then. And then after that you. Okay. Yeah.
Hello, myself, Cable. My question to everybody: since there is a report call from World Bank that there is a recession in US.
You get your mic closer to your mouth.
Yeah. There is a report called US is facing a recession. At one side, gold prices are shooting high. There is a report called there is a increase in the interest rate. Even there is a report called there is a financial crisis facing in the US and UK market. So will it have an impact on the Indian equity investors in the coming years and view of earning and valuations, its prospect of earning and valuations?
Mahesh, would you like to just answer it? Yeah.
No, so see, we have seen up till now, there has been some amount of decoupling which has been there. Okay, what's happening if you look at year till date, our markets are up by around 7%. Okay, I mean this calendar year. I mean, other market, including US, will be down around 15 to around 25%, 30% also. But I think beyond the point, I think if global economy goes into recession, okay, there is, if that is deep enough and you see some kind of a credit crisis, I think financial markets in the end are all interlinked. So you will see the impact on that. And India has done well. Relative valuations are much higher. So if I think from here on, I think we can't believe that India will continue to decouple from what's happening globally. I think you could see an impact, and that's why I think next year could be slightly more volatile. You could see some correction depending on how the global risk plays out. And there are possibilities of that. So one should be a bit cautious, and if we're getting into next calendar year, that's one of the risks which investors should really bear in mind. They should be willing to take some hit, some drawdowns in their portfolios. Though, I mean, the long-term outlook for India is all good, and we all know about that, so that should be good, but short-term volatility would be there because of these factors.
Okay, last question.
Hi, I am Arun. So we talked a lot about equity and debt. So my question is around, what about AIF or REIT or InvIT space? I mean, we are not getting a lot of traction there. In fact, AIF is giving more than 15% return. So is it like we are still not convinced with AIF space, or I don't know. I mean, we as a mutual fund industry, you guys are focusing more upon equity or debt.
Okay, fundamental question.
AIF invests in equity or debt,
Yeah,
so
AIF
that's
is
not,
more, yeah.
as far as REIT and InvIT is concerned, as and when more REIT and InvITs are issued, I think the industry will invest in it. So I think over the next few years, more REITs and InvITs will get issued, and the mutual fund industry will invest in it. AIFs themselves are not an asset class. AIFs themselves can invest in equity, long short. For example, we have a long short AIF. So there are different AIFs. AIFs themselves are not an asset class. AIFs can invest in equity, they can invest in debt, they can invest in distressed debt, they can invest in long short. There can be different asset classes, and mutual funds are not allowed to do that. They have to do it separately. They can't. Mutual funds are supposed to focus on only regulated asset classes.
That's right. Lakshmi, you want to add something?
No, so just that there are various mediums of gaining access to an asset class. It's a vehicle, it's a vahan. So mutual fund is one such vehicle, AIF is one such vehicle. If you want to do a credit fund, for example, you have a vehicle to do it through the credit risk category also in mutual funds, and you have private credit, distressed credit, performing credit, all of that in the AIF space. So yes, this category is mushrooming and it is here to stay. Risk appetite is visibly different. One is for a 5,000 rupee investor. Of course, even a 50 crore investor can invest. And the latter, or the AIF, is the threshold is 1 crore and above. And in some cases, the threshold is looking to increase. So both are very legit vehicles. Know your risk factors before you make investments into any of these through the vehicle for participation.
No Hindi song to end it? No.
Hindi, after listening to this audience, Hindi bol raha hai, ab thoda English ko
English. Okay, fine, done. Okay, fine. Now, I think we have come to the end of this wonderful session. I thought we learnt a lot, and with such a stellar panel, experts in both equity and debt, we discussed the impact of COVID and how the industry faced it. We discussed the many investment challenges, regulation, budget not being that relevant in a very marginal way, perhaps. Need for education, awareness. We also realized that debt and equity, the house was almost divided, in the sense that debt had a certain flavor to it, but equity was looking like little risk, and it is always it should be. One final thought: equity, debt, and beyond. That was the question that we raised. Is there anything beyond?
Basically, people forgot that you can have gold, silver, all these things. That's why we've been talking on multi-asset everywhere.
Yeah.
Because frankly, in a year where we think that Fed is going to stop hiking, an asset class like gold, silver may also perform. And this was a call we thought 3 months back. So I think that's why we thought of multi-asset as a framework.
Excellent. I think that's the thought which will end this. That probably the future is also about multi-assets. With these words, I think we'll call it wraps. And thank you very much, and give them a big hand, please. Thank you. Thank you.
Thank you so much, Mr. Bhattacharya and our stellar panel for that discussion. I think Lakshmi, I heard a lot of interesting metaphors. Shivai Brahmastra caught the attention in a debt equity kind of a discussion that we had. So thank you for that. And it was that we not only spoke about equity, debt and beyond, but far more holistic aspects such as creative product positioning, credit default swaps, and the need for our debt market to be more vibrant with the aspects of liquid market versus protecting the interest of the savers in the long run. I think the sharpness and discernment with which our panel members showcased their perspective really shows their analytical mastery of what the trends are looking like and their intuitive originality for their ability to predict the future of investment. With this, ladies and gentlemen, I request you to come back sharp at 3:30 p.m. We have a session and an address by Mr. Ashwani Bhatia, who is a whole-time member of SEBI and has over 3.5 decades of experience in diverse areas of banking and financial services. I'm sure he must be talking on a very compelling and immensely riveting topic. So requesting all of you to come back at sharp 3:30 p.m. in conference hall number 1. See you on the other side. Check, check. All right, welcome back, ladies and gentlemen. We'll do an alertness test because I know you guys are all wide alert and awake and really eager. So every time I say hello, you say hi, the tech check that we did yesterday. So hello. Very nice. All wide awake and alert. So we are at the biggest BFSI summit in India called the Business Standard BFSI Insight Summit. As we come towards the finale of this summit, and as you all remember, we started yesterday's summit with the Honorable RBI Governor, Mr. Das, and we had decided that we're going to conclude this summit on a high too, by bringing in front of you a speaker, a banking maverick, who's going to leave you all with too many meaningful insights and triggers to reflect upon. And I think we've done complete justice to that intent. So as we come towards the culmination, our finale address will be rendered by a whole-time member of SEBI with over 3.5 decades of experience in diverse arenas of banking and financial services. I'm talking about Mr. Ashwani Bhatia. And to introduce him and bring up close and personal his diverse experiences and expertise, I think I'd like to call on stage Mr. Shailesh Dobhal, editor at Business Standard. Sir, over to you.
Thank you, Ridhima. And good afternoon, everyone. On behalf of Business Standard, let me extend a very warm welcome to Mr. Ashwani Bhatia, whole-time member of SEBI. Mr. Bhatia joined the Securities and Exchange Board of India in June 2022. At SEBI, Mr. Bhatia handles various departments such as debt and hybrid securities, alternate investments, funds, foreign portfolio investors, regulation and supervision of markets, intermediaries and the corporatization of finance investigation as well. In the last 6 months, SEBI has delivered crucial orders in matters such as credit rating agencies, commodity brokers, and RTAs, among various others. Prior to joining SEBI, Mr. Bhatia was associated with the State Bank of India Group in various leadership roles, managing treasury operations, retail banking, credit, investment banking, and asset management. During his tenure, he has held the position of Managing Director of State Bank of India and also served as MD and CEO of SBI Mutual Fund. That's the biggest mutual fund in the country. In his association of over 35 years with SBI, he rose from an entry-level probationer to one of the most trusted names in the capital market. He holds a BSc in Physics and Mathematics and has done his MBA in Marketing from the R.A. Podar Institute of Management, Jaipur, which is affiliated to the Rajasthan University. Many thanks, Mr. Bhatia, for taking the time and the trouble to be with us here. May I now invite you to please come and address this audience and thousands of others who are watching this program online on Business Standard website and social media platforms. Please, Mr. Bhatia, the stage is all yours.
Thank you so much. Ladies and gentlemen who are present this afternoon here, a very good afternoon to all of you. It gives me great pleasure to be part of the BFSI Insights Summit that is being hosted by Business Standard as we approach the end of an eventful financial year. Just as we were getting back to full normalcy, the world, we believe, had moved back to normal. News now comes that the new strain is appearing to be dangerous. With renewed hope that this strain weakens, let us take few steps towards 2023. The preamble of SEBI describes the basic functions as to protect the interests of investors in securities and to promote the development of and to regulate the securities market and for matters connected therewith or incidental thereto. SEBI's regulatory jurisdiction extends over listed entities, intermediaries, and persons or entities associated with the securities market, and hence its responsibilities weigh in each such bucket. SEBI has been a reform-oriented regulator in tandem with the development role enshrined in its preamble. This year has been no different from the past. Let me begin to outline recent reforms. I'll be talking about some numbers, some statistics. First, on the equity side, the amounts raised through equities during 2022-23 are quite low as compared to the past financial year. In financial year 22, we had total raise of about 1.39 lakh crores, comprising of 1.12 lakh in the IPO and FPO side and 26,000 on the right side. This year, as I said, a little subdued. 42,000 is what has been raised through IPOs and about only 1,200 from the rights issue. On the debt side, after seeing a high of 7.8 lakh crores in FY 2021, that was mainly on account of TLTRO, low rates of interest, liquidity, so on and so forth. This year, so far, we are down to just 3.15 lakh crores. We are still yet to see the last quarter, which is supposed to be most active, but we do think that the total raise in equity will be around 5 lakhs. The amounts raised, as I said, in both equity and debts have taken a dive because of multiple factors, including geopolitical events like Russia-Ukraine war, etc. It's heartening to note that the number of demat accounts have crossed 10 crore, though it is a far cry when you compare it with the number of savings bank accounts that you have in the country, which is 150 crores. The very fact that it has grown over the past 2 years for us is encouraging. The number of unique investors have also increased from 3.6 crores in November 21 to 4.37 crores in November 22. On to the major reforms. I'll start with the mutual fund space. So very clearly, as all of you know, in November, the AUM of mutual fund industry crossed 40 lakh crores. This is a phenomenal number. So let's think about it. 5 years back, we had just crossed 20 lakh crores. So in 5 years, we've seen a CAGR growth on a simple basis of around 20%. And look at the SIP numbers. Last month, we saw 13,307 crores coming in. And I was talking to one of the CEOs, and just think about it, 13,300 crores in a population of 140 crores gives us, on an average, 100 rupees per investor, per population, per capita, per month, right? And this has brought about stability into the markets. What should be a number that you dream at? In 5 years, if we can touch $5. Now you'll say, why am I talking about $5? 100 rupees translates to $1.2. So if this becomes 5, the SIP number that we are talking about in 5 years can possibly hit 50,000 crores. These are the numbers that we talk about, and it is possible to achieve that on a monthly basis. Look at the numbers again. In financial year, about 5 years back, when the AUM was 20 lakhs, the AUM to deposit ratio was 18. Today we are touching 23. The AUM to GDP, which was 12, has now touched 16. Global average is 60. So 4 times that, and you can very well imagine the potential of the mutual fund industry. So looking at this growth, looking at the fact that money cannot be misutilized in the mutual fund industry, the fund management and all the processes today have been strengthened. We have brought about significant changes in the way mutual funds are run. I'd just like to highlight these to you. We have reduced the time period for redemption and payment of dividend in mutual fund units. Guidelines have been strengthened to develop the passive debt funds. This also includes issues like the Bharat bond, so on and so forth. And we want more funds to come into government securities and SDLs as underlying index constituents. We've introduced performance benchmarking. We've introduced MF units for prohibition of insider trading regulations, discontinuation of pooling of funds and securities for transactions in mutual fund by intermediate entities, which means brokers and MF distributors, uniform stress testing norms for open-ended debt schemes. Recently, in the board meeting that concluded day before yesterday, we've also launched the platforms for investing in direct plans. So this part of the capital markets, we believe, will grow. Good way to start as far as investment is concerned. In the mutual fund space, things have gone about pretty well. After intensive consultations, we did, if you recall, bring down total expense ratios, come to a trail model. I think all of these initiatives are helping the markets. So if you have a good distribution, the distributor recommends and advises a customer well over the long run, he earns more money, the investor gains, and the trail model actually helps. The reforms in the portfolio side, based on past experiences and learnings, SEBI has taken the following policy initiatives with respect to the portfolio managers: enhanced prudential norms for portfolio managers regarding investments in your own associates, related parties, and the minimum credit rating for all investments by portfolio managers, strengthening of policies and systems for fund management, including order placement, execution, and trade allocation by portfolio managers, and enhanced requirements for performance reporting and benchmarking by portfolio managers. The above measures are intended to facilitate enhanced disclosures for investors, which will aid in better investment protection and development of markets. PMS, we think, can compete with mutual funds too. To provide greater investment flexibility to managers of AIFs and to facilitate deepening of the domestic corporate bond market, we have decided to permit AIFs to participate in credit default swaps, not only as protection buyers, but also as protection sellers, subject to conditions. SEBI has also recently formed a working group to look into matters relating to credit default swaps, including implications for mutual funds. We think reform in the CDS market will help the bond market to grow as well. Let me turn to the bond markets. Over the past few years, the bond market has emerged as an alternative to the banking sector, especially for top-rated firms. There is need for mobilization of funds from the corporate bond market as it provides an alternative source of finance and supplements the banking system to meet requirements of the corporate sector to raise funds for long-term investments. To my mind, it also reduces the risk to the banking system. It is believed that this segment acts as a stable source of finance when the equity market is volatile, and also enables firms to tailor their asset and liability profiles to reduce the risk of maturity, etc. Deepening and developing Indian corporate bond market has received close attention, and much of the changes will take effect from the 1st of January 2023, which include the threshold for bond issuances in electronic bidding platform, which has been lowered to 50 crores. This started at rupees 200, then brought down to 100. This will now bring it down to 50, so you're getting more transparency over there. Issuers can also reserve up to 30% of the issue size to anchor investors. The face value and trading lot has been lowered from 10 lakhs to 1 lakh to increase investor participation and ensure liquidity in bond markets. Brokers in debt segment have been permitted to place bids in the RFQ on behalf of clients. Earlier, this was only on proprietary basis. Online bond platforms have been brought within the regulatory ambit. They have to be registered as brokers, and in the debt segment, we hope that with these platforms, the participation of retail investors will go up. The timelines for private placement of debt securities has also been reduced from T+4 to T+3, enabling issuers access to faster money. The cap on ISINs will also reduce fragmentation and enhance liquidity. On the sustainable finance side, the increased interest in sustainable finance in India as well as around the globe, and with a view to align the extant framework of green debt securities with the updated green bond principles recognized by IOSCO, SEBI undertook a review of the regulatory framework for green debt securities. Based on the review, it has been decided to enhance the scope of definition of green debt security by including new modes of sustainable finance in relation to pollution prevention and control, eco-efficient products. We have introduced the concept of blue bonds that relate to water management and the marine sector, yellow bonds relating to solar energy, and transition bonds as subcategories of green debt securities. SEBI will also specify the basic do's and don'ts relating to green debt securities to address issuers against greenwashing related risks. These were discussed in the recently concluded board meeting. We don't want any problems here in the future. So in letter and spirit, we expect the issuers to follow guidelines and do not misrepresent. On the REITs and InvITs, with the introduction of REITs in India in 2014, SEBI provided an avenue for investors to participate in real estate and infrastructure sector while affording the developers a mode for monetization of their assets. Freeing up developers' capital is also expected to bring in more investments in real estate and infrastructure. The government announced the monetization of assets program of 6 lakh crores to be done by PSUs through setting up of InvITs. Further, recognizing the need for debt finance of REITs and InvITs, the government has proposed amendment to various laws and recognized the ability of REITs and InvITs to borrow and proposed a framework for enforcement of debt contracts entered into by REITs and InvITs. It's early days, but as far as InvITs are concerned, today we have 13 InvITs and 3 REITs, which have raised more than 1 lakh crore from the market. Assets of more than 2.2 lakh crores are today held in these trusts. There were some teething problems initially, which have been resolved, and various aspects of the issuance, listing, taxation have been clarified and rationalized. As public money is involved, and with the lowering of minimum investment and trading lot for InvITs, we expect to see large participation from investors, especially small retail investors. REITs and InvITs is an area of continuous focus for SEBI, and we'll continue to work on this to improve market access for retail. We will continue with a view to keep regulatory objectives and business imperatives on an even keel. Municipal bonds. SEBI issued municipal bond regulations to provide a regulatory framework for governing issuance and listing of municipal debt securities. The numbers not very encouraging. Only 8 municipalities have raised 1,690 crores through municipal bonds. Recently, in November, Lucknow Municipal Corporation raised 200 crores through such an issuance. We are in consultation with municipalities, investors, and market participants to provide for changes related to definition of issuer, preparation of accounts, facilitating ease of issuance, provision of escrow mechanisms for repayment of debt. SEBI has embarked on an outreach program to reach out to municipalities across the country to use the bond market route to tap bond markets. SEBI recently clarified that municipalities can issue green muni bonds to facilitate them to tap sustainable finance. On the equity side, we have made changes to the IPO valuation norms. SEBI has prescribed adequate and sufficient disclosures about key performance indicators. Disclosures on KPIs has been introduced to enable investors to evaluate on same parameters as pre-IPO investors. Disclosures of weighted average cost of acquisition by promoters selling shareholders ensures information symmetry to public at large. The buyback through stock exchange route is being phased out in a gradual manner. The minimum utilization of the amount earmarked for buyback through stock exchanges has been increased from existing 50 to 75. A separate window on stock exchanges is being created for undertaking buyback. On buybacks, we want complete transparency. So in the recent changes that we've brought about, the reduction in timelines for completion of buyback by 18 days by removing the requirement of filing draft letter of offer with SEBI and its observations thereof, and reduction of the duration of tendering period and period available for payment of consideration to the shareholders, permitting upward revision of buyback price until 1 working day prior to the record date, making it mandatory to place the relevant advertisements documents with respect to buyback, such as copy of public announcement, letter of offer in the respective website of stock exchanges, merchant bankers, and the company for better dissemination of information to shareholders. These amendments aim to streamline the process of buyback, create a level playing field for investors, and promote ease of doing business. This will help existing shareholders in buybacks to a very, very large extent. We've also made decent amount of reforms for the broking community. Certain stockbrokers in the market handle a very large number of clients, very large amount of client funds, and trading volumes too. Possible failure of such brokers has potential to cause widespread impact on investors and reputational damage to the Indian securities market. To mitigate this risk, SEBI would be designated such stockbrokers based on identified parameters as qualified stockbrokers. We think there are 16 in this category. QSBs would need to comply with enhanced risk management practices and requirements. There would be enhanced monitoring of such QSBs by SEBI and market infrastructure institutions. It is pertinent to note that after seeing around 30 brokers default in the past 2-3 years, SEBI has brought in new 30/90-day settlement rule in India's stock markets, where brokers are required to transfer unused funds back to client accounts at least once a quarter. This resulted in brokers returning 32,000 crores to investors in one day in the first week of October. All this happened seamlessly. This is something unprecedented. Thus, SEBI looks to understand risks, and it was essential in this case to ensure that the cash securities do not lie permanently in the hand of the brokers. To conclude, SEBI will continue to reform the capital markets with pro-business and investor-friendly measures. Increase in SIP numbers, AUM, the market capitalization, so on and so forth, are positive numbers indeed. SEBI would like to have informed investors in the market because that is how markets can grow. We want long-term investors to celebrate the India story. We also understand that it is difficult to be ahead of the market as far as regulation is concerned, but with data and through the consultation process, we will make changes to ensure that the securities market runs smoothly and are safe for investors and meet all challenges. We will leverage technology, we will leverage data because digital is the way ahead. Thank you very much for this opportunity. All the best to all of you and a very happy and prosperous 2023 to all of you.
I think truly thorough, immaculately prepared. His stats, his data were too much on point. Right from painting the picture that SEBI is a reform-oriented regulator to enlightening us all what is the bond market and AUM under mutual fund looking like. I think it painted a stellar picture. But to do more justice to actually capsulate takeaways from this part of the conversation and to render the vote of thanks, can I call back on stage Mr. Shailesh Dobhal, Editor, Business Standard.
Thank you so much. You've asked a lot from me, doing justice to such a brilliant address. But thank you so much, Mr. Bhatia, for a very realistic and yet very reassuring and inspiring address. And why I say realistic, because you very clearly laid down what has happened in terms of funding has slowed down, and you gave numbers for all that slowdown that has happened, and yet you very clearly laid down the thresholds that have been crossed in terms of number of demat accounts, number of unique investors, the assets under management under the mutual fund industry. And then you went down as to what SEBI has been doing in terms of regulations of mutual funds, PMS, alternate investment funds, even the bond markets. You very clearly, very deeply laid down as to what is happening there. REITs and invest as well. How equities, the disclosure norms have been tightened and made simpler. And yet you tied down the whole thing to what you said at the last is you want to push the India story, be the referee between savers and investors. And the thing that I liked best about the one takeaway for me was as the country chases the 5 trillion economy, you spoke about the 5 trillion size of the SIP market per investor per month, right? Am I right? But the aim is in 5 years, $5. So the 5 trillion economy and the $5 SIP per ticket, per investor thing brilliantly works together in that sense. So it's a very inspiring, very detailed lecture. Thank you so much, Mr. Bhatia, for doing it for us, for Business Standard, for being here. Thank you once again. A big applause for Mr. Bhatia.
All right, ladies and gentlemen, with this amazing session, we come towards the conclusion and culmination of Business Standard BFSI Insight Summit. You've been a lovely audience. Hopefully, you went away with far many meaningful triggers, questions to ponder on, and most importantly, some true inspiration for taking action.